Good morning, good afternoon, and good evening to everyone from all parts of the world who have registered for this great event happening today. I hope you and your family are doing safe in the COVID times. Our best wishes are with all of you. Today, we are having a great event related to technology in banking and financial industry. Along with the seven great talks, what we have for today, we have a great power-packed panel discussion. The subject matter of that panel discussion is the outlook for a smart banking industry driven by AI, which will add a flavor and also provide you deep insight into how AI and other emerging technologies will have an impact on banking and financial industry. So, before setting up the tone, let me begin with introducing myself and the company to you. My name is Nitin Naveen, and I'm the Vice President Innovation Strategy at AI CoreSpot. I'll be your host for the whole day. Further, I have been joined by my colleague Arvind and Naveen, who will also assist me in keeping the event lively and resolving technical glitches if it comes in between. So, thanks a lot to them for putting in hard work and making this one a huge success. We'll try to provide a seamless experience to all of you so that you can get some output out of today's sessions. Let me provide a brief background to all of you about AI CoreSpot. We started last year, backed up by our technology partner Digit7. Our focus is to provide all of you a deep dive into all the sectors wherever technology is there. And every month, the theme we keep is different. Also, we are gaining momentum month on month. Our aim is to be number one AI driven community all over the world so that like minded people like you all can be a part of the same in supporting, growing, and making it a success. We'll continue to do industry backed webinars and hybrid events. The knowledge repository will be made from reliable data through industry leaders, subject matter experts, and the thought leaders. We'll enrich the content through videos, blogs, podcasts, newsletters, and digital content to shed light on the ever evolving industry. Our mission is to serve as a hub for information regarding Industry 4.0 technologies, which include AI, ML, deep learning, robotics, blockchain, IoT, edge computing, analytics, 5G, drone, edge AI, digital twin, AR, VR, cloud, and so on. Today's event is one series of events which we have planned for this year. It's power-packed with speakers' presentations and panel discussion themed around how AI is transforming the banking and financial industry. There are lots more in store for subsequent months as well, with focus on retail, e-commerce, factories, supply chain, aviation, and so on. We keep on adding new topics to our list, so request all of you to go through our website, that is aicorespot.io, for future updates. Also, please like our social media handles, which will keep you all updated on everything what we propose to offer in the coming months. So before starting with the day, I would like to highlight few things so that it can set up the tone for the amazing learning and networking day. A special mention to our technology partner Digit7, who has helped us in understanding our vision and supporting us to create a platform through which we can help achieve our objectives. Their support is immense and provided us a push to create awareness about emerging technologies in the Industry 4.0 era. So let me present a slide to all of you about Digit7 so that easy for you to understand what Digit7 is offering. Yeah. So this is about Digit7. So Digit7 is creating platforms and products that solve industry problems and leverage emerging technologies. So there are 15 plus patents with them, and the main focus is on the four products which you can see: IoT Shells, Tag Square, Z Store, and the Fly Robo. The focus is on creating sustainable and solid business value. So what is the USP of Digit7? What the products they are offering? They have built-in flexibility. They have inherent scalability. The event-driven architecture is absolutely fabulous. The timeline is faster and it is very much secure. And the biggest thing is the cost is amazingly lower compared to any other competitor in the market. So This is the USP of Digit 7, and request all of you to go to the website, which is digit7.io, and understand more in depth about what they are offering. Also, thanks to our community partners for today, which includes InfoVision, Fair FinTech, Octane, Green Payments, Blend, Regions Bank, Optimal Financial Systems, Empower Financing, Old Second National Bank, Castellum.ai, and TCS to make this event a success. A special mention to the speakers and attendees of the event who registered and came today to achieve their objectives through this platform. At the end of the day, if you gain few things out of this or get to network with each other, then our core objectives will be achieved. Further, if anyone wants to ask questions, they can type in the Q&A section, which is there at the right corner of the menu option. You can type in as and when the speaker speaks, and we'll try to get it answered after each talk or as per the time permitted. There's also a hand button at the bottom of the screen through which you can even raise the hand and come to the stage to ask questions to speakers as well. So let me go quickly through the agenda and let you all get introduced the speakers and their topic. Hope the screen is visible to all of you. This is the website of the company in which the agenda is there. So we'll be starting with our first speaker, Shiva, who is the Senior Director at InfoVision. His topic is digital role in fintech. Then we have Himanshu Sharma, who is Chief Information Officer from Fair FinTech. His topic is neobanking. Then we have James Cowell, who is Vice President of Credit in Octane. His topic is ML, AI in lending and credit analytics. Then we have a great panel discussion moderated by Chitrai, who is the CTIO of InfoVision. Then we have Ben Ross, CEO of Green Payments, Harris Ikram, Head of Product Management Mortgage Products in Blend Company. Jacob is their Head of the Model Risk Regions Bank, and Aaron Gete, who is Advisor and Investor of Optimal Financial Systems. It's a great 1 hour panel discussion. Then we move on to our next presenter, who is Ken, VP of Credit Innovation, Empower Financing. His topic is developing and implementing AI ML in operational functions. Then we have Andrew, who is EVP and CTO of Old Second National Bank. His topic is the use of machine learning and artificial intelligence by financial institutions to manage BSA and AML risks. Then we have Peter, who is co-founder and CEO of Castellum.ai. His topic is automating compliance. And the last topic for the day by Pranav Kansara, who's Senior Director Analytics and Insights in TCS. His topic is potential and perils of AI in banking. So hope the stage is set for all of you to start the day. So without wasting any time, I'll hand over the stage to Shiva, who will take the proceedings and take it further from here. Over to you, Shiva.
Thank you. Thank you so much, Nitin. Thanks for giving this opportunity. Good morning, good evening, good afternoon, wherever you are taking up this session. I'm really happy to be part of this session. I thank the organizers for giving me this opportunity and really happy to meet you all virtually. Thank you so much. My name is Shivakumar. I am part of InfoVision and working as a senior director for emerging technology platform. Today, we will talk about what is a major role that we are having in fintech, especially on the digital role, right? So, digital role, what we are having, and what are the things that are there, opportunities, and other things. So, we'll, without wasting any further time, let's get into the session. I'm going to share my screen. Hope my screen is visible. All
I'll
right.
let you know, Shiva, once it becomes visible. Yeah, it's visible and big.
Fantastic. Okay. So, when we talk about digital role, right? So today we will cover what is the trend, what are the integration options that we have, how the journey has come, especially on the fintech in the digital side, how fintech has become a talk of the town. and what are the bigger opportunities that we have, and what is the global market insights. We will also talk about major shifts that are happening. We will also talk about how customer empowered model emerged over the period of time, and some of the challenges. Of course, any new shift or trend that changes will always come with freebie of some challenges, which we will always be able to address, and how bright the future banking for us. Okay, and especially in the banking and financing sector, how much opportunities we have, what are the things that we can do, and I'll just talk about that in the last slide. With that, okay, we'll quickly jump on, right? So, as we all know that we are going through this pandemic, and I'm sure we'll be coming out of it. But this has a different impact with respect to the industry as such, as well as the digital platform, emerging digital platform as well. And when we talk about this particular area, right, the COVID has really transformed this industry into a different model. I would rather call it as a new normal. That is what is going to be there, and there is a trend is very bright for us. And here, if you look at and today, we don't need to be a real big person to be reachable across all the organizations or finance institutions across the globe. In a fingertip, we can go ahead and reach out with the help of fintech. We can quickly start a fintech organization, add many of the products that are contributing or complementing to the financial institutions that can really bring up new products in a snap of a finger. And that's the brighter feature that has really opened up, and it has really picked up very fast with respect to the pace and acceleration. And many of the people have not even having the banking accounts have started doing banking, and without even knowing that they are doing it, that has become a very different way of working. And I could sense that when I talk to many people, I could sense that many of them have started really going digital, and situation has forced it, and regulations have been simplified. We will talk about that in upcoming things. And when we talk about financial sectors, it is including both private and public sectors, and they have started working towards the fintech integrations, which we'll also cover. So what is there in the market, right? So we the fintech as an industry, what is there in the market? If you look at, we all know that there is B2B, B2C, and there are plenty of opportunity which you can see on the screen. But one of the things that really has attracted, to my understanding, is there's a clear opening that is coming up on the C2C market, and that has really taken up a pace. And digital wallets have extraordinarily improved, and we have seen many transactions coming. If you look at, by 2025 we will be having 4.4 billion business transactions happening, which is not the case in the 2020, right? And if you look at the embedded payments, that's another area which I would like to highlight here. Is basically, there is a clear study that has really brought up to, which we all should have to think through, is moment you create a product offering that is really having embedded payment into the platform, you will see a spike on the number of customers, and that's going to really generate a huge business for us. See, looking at these, right, it really gives you a kind of a jump start for all of us to see how we can bring business, how we can grow business exponentially with the current situation and pandemic that we have, and what are the doors open for us on many of the venues in fintech, right? So, what is the, if you want to nail down very quickly, what is that really taking us to the trends so far, right? And when I say trends, of course, there will be plenty of solutions available, but there are certain areas where we can really look at as a core business area where we can pitch in. Sorry.
நல்லா இருக்கீங்களா?
Chitrai, can you please be on mute?
ஆக்சுவலா நானு படிச்சுட்டு நான் உங்கள்ட்ட வரலாம்னு நினைச்சிட்டு இருந்தேன். ஆனா நீங்க அதுக்கு முன்னாடியே
Nitish?
வந்து எதாச்சியா நான் இன்னைக்கு ஆக்சுவலா உங்க ப்ரொஃபைல் பார்த்தேன். நீங்க ஏதோ பிளாக் செயின் ரிலேட்டடா ஏதோ பண்றீங்களா அப்படின்னு சொல்லிட்டு அதுக்குள்ள வந்து நீங்களே
Nitin? Nitin?
Yeah, sorry, I think there was a technical issue from his side. No issues.
Yeah, sorry about that.
We can carry. We can carry.
Yeah. So, hope my screen is still visible because I switched.
Yeah, it's visible. Visible,
Nitin?
visible.
Okay, fantastic. So when we talk about these trends, right, definitely decentralization of finance has come. Especially the white labeling is something that which has really attracted. See, now today bank has many products and services, and they have started getting into digitalization long time back, and suddenly there's a huge need of different products and services that can attract more customers, grow the revenue, and these fintech based organizations can really provide multiple products, and that can be white labeled, that can be white labeled as well. All the financial institutions are really looking at outsourcing some of the technologies to through a major fintech players, and that has become a very good opportunity for fintech players, especially to build any digital platform. Of course, ballots, and there's nothing really amazed us, because in last 2 years you can see mobile payments ballots have really brought in. Even if you look at India, GPay, Beam, Paytm, Phone Pay, government started integrating to this platform. They started introducing these platforms, and really has picked up huge traction here. And one of the things that many of the people think of when we talk about BFI, how are we going to do on the VR side? Okay, that's a very interesting trend that is going on. I would rather call it as it's really taking some more time to come out with a clear use cases. But I can easily see that Google, Apple, Facebook, Amazon, all these major players are already actively working on some of the paradigm change on the customer expectations. For example, BNP Paribas started working on launching the VR based solutions, wherein they will be able to do access the accounts virtually and make transactions through VR environment. Okay, Bank of Kuwait already started utilizing VR as a new branches for them. They have started looking into this. There is a huge potential here that we can really look at. Even the fintech companies like Arcons, they have started providing virtual cards, right, and debit cards, and all these things have started picking up in this area. But it will take some more time to get more clear use cases. Of course, blockchain is there, and we also have autonomous finance and data aggregations. So, one more important thing I could say is gamification has really picked up in a different model, especially on the handheld devices, right? And many of the banks have already started looking at how do I make transaction, how do I know my balance of my account and other things. So all the fintech companies started creating many gamification applications and publishing it. Major shift that we are seeing as a trend is the quantum computing. Today, the large transactions processing are taking some more time, which is going to be drastically reduced with the quantum computing. I think that's going to be the best way to give a best customer experience for many of the financial institutions. Of course, open banking is an area where I would really call it as a boon for us, and especially they have an opportunity to interact with fintechs, and many of the fintechs digital applications can seamlessly connect the data and get it. But it has its own pros and cons, which we will see that in upcoming slides. And before I jump into the next slide, one important thing I want to cover here, couple of things. Buy now, pay later model is picking up as per the research and trends. Many of the companies, fintech companies like ClearPay, Laybuy, are also started doing this. So this has become a kind of a lending model and the fintech level, and many of the applications and integrations started happening. I think that's going to be a major trend, and it can even become a threat for financial institutions when they start doing this a lot of lending activities. And fintechs is also eyeing on payroll. Payroll processing is something that they are also eyeing on, and that's what is the trend I see as of today. And I'm sure its list is very big. I just thought I'll keep whatever is highly important. Of course, the rest of the things like device-based financial flow, AIML, all these are part and parcel of both financial institution as well as fintech. Now, let me jump into the next one. Basically, what I'm talking about here is the major shift that has happened in last 18 months. I would say when the fintech started showing its phase into it and started working towards many of the products, new products and services, integrating multiple financial institutions to the single platform and seamlessly transfer data from classified, unclassified data in a different regulations in place. There are many things that they have acted as a kind of a bridging platform, and the aggregators have acted as a bridging platform. And one of the things, for example, right, 10 years back, 15 years back, if I have a very good credit history here and I go to London, right, and I try to establish my credit from scratch, they will say that you don't have a credit score now. Now, today it is not the case. Today, wherever I go, my credit history can be easily picked up and seen how it is, and they can immediately issue the card, and I can start transacting. So there are plenty of opportunities that has really brought up, and it has become real time. Okay, and the processing time has been cut down drastically. That's a major shift I see with respect to the customer experience. Of course, all these major shifts will definitely have both back office solution as well as challenges and customer facing experiences as well. When we talk about
Shiva,
global,
your PPT is not visible.
it's not
Yeah, now it
visible.
is visible. Now it is visible. Yeah.
I don't know what happened. I was able to see that. Sorry about
Okay.
that.
No, 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 it is
Uh,
visible. Okay.
so it looks like technical issue. So now, when we talk about data exchange, right, and many institutions start working with multiple fintech organizations and startups or any bigger players as well. There's a huge investment on cyber security and data privacy needs. Okay, if you look at Infovision is also partnered with some of the cybersecurity solutions, and we have partnered with Digit 7 as well, and we have many other partners on many of the activities with respect to data security and privacy solutions. Now, this has become most of our experience all along. We have seen that this has been the talk of the town, especially when you have too much of integration with different organizations and start sharing the data. Now, social platform, another major shift. Now, all along we are looking at social platform is a platform to collaborate, but it has become a place for innovating solutions, wherein most of the digital payments have started. Even today, you can look at WhatsApp has started giving that option of paying through WhatsApp, and many of the people have started having digital wallets in their own system, right? So, and most importantly, the customer mindset has completely changed now. Customer doesn't think that he needs to go into a computer to look at what is his accounts, how he needs to do the transaction. He has to go to the bank, and all those things have completely gone handheld. And he thinks that anywhere in the world we have an account, I want to do a transaction. It's a matter of proper authentication and transfer. So the complete paradigm change in the way they are doing banking and finance has really changed. In fact, if a lending process or any of the pledging process, everything has become much simplified and it is global, and it has really changed the way financial institutions and fintechs looking around their products and services. And that really has brought up more of liberalization with respect to their policies at the international boundaries. And it is expected that this huge amount of transactions are bound to happen in future, and that's going to be driving a lot of growth for financial institutions and fintechs. Now, one of the major things that I want to call this as a open data protocol that really has been a practice for many of the financial institutions integrating with fintech, and it really brings a kind of a option for them to have tailored financial products, right? And all these everything is completely on microservice based model, and it's all service APIs. And we definitely see a huge opportunity with respect to the digital technologies, especially on the cloud-based platforms. We have huge opportunities there. And see, one of the things that I also earlier mentioned is about the account aggregators. So all these account aggregators are becoming more prominent and visible in this whole of the cycle of financial institution as well as the fintech organization coming together and trying to bring in a best service to our customer community. And they have become account aggregators have taken a major role on becoming an intermediary between the data providers and data users, and they have been doing coming out with many of the database solutions, cleansing, maintaining the data, transferring the data, looking at the personalization, privacy policies, and so forth. So they have really started looking at many of the additional things that they have never mentioned in the initial stage, right? And definitely there needs this particular change in behavior with the impact of fintech is looking good. There is some downsides there wherein we will have to really govern many of our data privacy policies and compliance, and that's where multiple players are involved, right? So financial institution has to be very, very cautious about it when they are partnering with these people, right? So now let's quickly look into how we transformed, right? In past, we were actually given a set of products and we were asked to use it. Now today, the situation is completely different. What happened? As I am a customer, I choose how do I operate my accounts in a Bank of America, okay, through a fintech guy. I don't even need to go to a particular bank site to look at what is my balance. I don't even need to look at how do I transfer money to my vendor by getting into the company's website, bank's website, user login, and then going inside. I just can do it direct fintech organization, and they decide whether I'm interested in the loans, I'm interested in the credit cards, or points based model. Everything they decide. Okay, customer decides, and platform is adding more and more products with the help of fintech. I think more hyper personalization is going to really rule the world. Now, when we talk about all this fintech journey, right? We and financial institution journey. Initially, we were doing the digitization, lot of manual process we moved. Then we went into the digital banking, where we had this complete analytics in the back office, front office. We had multiple device support, responsive design solutions, payment through partners. Everything we started working towards. What is there in the new future banking so far, right? There are many solutions, especially self-service platform has really shaped up in a different way, and more of e-commerce based integrations will have in the bank, and money data money with respect to various countries are treated equally, and it is getting transferred seamlessly, and the integration is fantastic. Everything is through microservice architecture, API based model, so anybody can subscribe as long as they have the proper approvals and credentials given by the bank and fintech organizations. and a lot of things like it's not going to be that now moving forward somebody will come in front of you and say what do you want, you have spent last month this much in this area, these are the opportunities that you have this much money in this account and this can be invested here, this can bring in some kind of a profit or a return of investment. So all this mentoring and everything is going to be VR based, and that's what is banking is looking at, and plenty of things like end-to-end financial services, personalized, hyper-personalized, and all these will be done through AI, ML, CV, AR, VR, and blockchain. And what does that it offer is it's an ultimate customer experience end to end, and it also increases the customer base for the financial institutions and seamless experience across all the fintech organizations. So some of the challenges, of course, fraud management is always there, and this is going to get more predominant here. And technical collaboration, especially when you have multiple fintech handshaking with a financial organization, and fintech to fintech is a handshaking. There are many technical challenges that we will come through, and especially in this kind of BFI platform, downtime is not allowed. So we have to be really be on top of it, and data consolidation and classification on the fly and real time should be properly monitored and governed. And see, banks are unbundling their services and giving the open platform for fintechs to pitch in and enhance their services in no time. The reason being is they want to exponentially grow the customer experience, and that really have its own downside, which we will have to look at how do we do that. Of course, definitely we will have to work towards seeing how we can cater equally all the products and services in B2B, B2C, and C2C, and each one of them has to have unique services. So it's not like you have 100 products and we end up using only 5 or 10. That should not be the case. So when we partner with fintech or many of the even financial institutions look at the fintech products and services, and then they assume that this will work out, and they are still struggling in my view. And definitely this really has to go into the next level, and we are still, I would say, we are still in the intermediate stage. We still have to grow bigger in fintech. And what will happen is when you have too many products and services, it's going to be very difficult for us to pick right products and services that will really boost my organization value. And especially when I'm catering multiple type of users, B2B, B2C, and C2C, it's really going to make a difference. It's going to make a difference only when you have a unique products and services, and that's where we have to spend more time, and that's a time-consuming one because it has to be predicted very well. Before one slide before I finish, I would rather call these as a big opportunities. The reason being is I categorize this into 4, right? One is the personal data, behavior of the customer, predictions, and customer-centric approaches that really guides even the financial institution. And that is where the whole ecosystem of BFI, financial institution, and fintech getting together is going to make a huge difference. And these are the opportunities that we have, and especially the transparent banking, real-time processing, lesser the fee, and all these kind of market-enabled solutions will really take fintech and financial institution industry to a next level of experience. So the feature banking, okay, a person as an individual, I do all the things that you see on the left. Medical expenses, business transactions, transportation, I go in bus and come. All these are listed on the left. I pay education fee, I do a travel and logistics, I pay for my pension funds, I spend on movies and entertainments. But how do I do that? I do it through many of the things that is available in the banking and service. And what you see on the right is that many of the opportunities and the future banking that we have, it has been a fantastic thing, especially the omni-channel options. It's going to be a fantastic one, and AIML based financial mentor option is going to really rock. And there are plenty of opportunity. I'm not going to go through each one of them, and some of them are very interesting thing like Robo Helper and Digimentor. So this is going to really take the experience in a different way. All putting together, we have a very, very bright future in financial institution, fintech, as long as we know whom we shake the hands and how we utilize their products, how we take it to our customer, and how we enhance our customer base to become bigger in the marketplace. So with that, I think thank you so much. I conclude my session. I'll hand over to Himanshu. Thank you so much for your time
Thank you,
listening.
Shiva. Thank you for the lovely presentation. It was very insightful, has a lot of data, a lot of facts and figures, and which set up the tone for this exciting day.
Thank
Thanks a
you.
lot. Love to
Thank
have
you.
you as a speaker. Yeah. So, guys, we'll quickly move on to our next presenter, is Himanshu Sharma, Chief Information Officer, Fair FinTech, and his topic is neobanking. May I have you, Himanshu, on the stage, please?
Hey guys, so let me share my screen. Okay,
Perfect.
so hello and welcome everyone. I'm Himanshu Sharma, based in Houston, US. So Houston is famous for NASA and oil industry, right? It's mostly warm and humid, but suddenly this week, like there's an unpredicted cold front, so which is rare. So it's slightly cold here. I want to thank you all for joining us today. I have created a poll also to understand like what you think about fintech. It's a lot of talks are going about fintech. It was something not new, but something exciting today, right? So for current topic, the role of artificial intelligence within the banking sector, like I will try to discuss the use of AI in neobanks, and the topics I will try to cover is like what is fraud detection, how AI use their KYC, customer service. But before that, I want to go into what is a neobank. So stay tuned to learn more about it, and feel free to drop your questions. I will be watching for those, and I will try to answer your questions by end of my presentation. So with this, let's start. Thanks, Nitin, for providing this opportunity. So, role of artificial intelligence within the banking sector. I hope you guys can see. Like Nitin, my presentation is clear.
Yeah, it is clear, absolutely
Awesome.
clear and visible. And you are also
Awesome.
visible. Thank you.
Awesome. So, provide some detail about myself. So, currently, I'm building neobank, which is known as Fair FinTech. It's here in Houston, and it's a completely digital banking, right? So, we start everything from scratch. There's no physical branches for Fair. So, the strategy is new, right? It's new banks are there for some time, but it's getting a lot of momentum now. COVID is one of the I will say like initiator and accelerate the overall progress of new banks. I'm also a pioneer in open banking. Like in my previous organization, we have set up open banking APIs for prepaid. There were none earlier, so a lot of client base moved on our open banking, right? Particularly in prepaid. Then lead digital transformation in multiple banks. We built prepaid card processor and program manager in my last organization. So I was leading that. It's a great experience. Like when you build everything like within one organization where you're doing the card processing and program management, right? So huge work there. I'm also advisor and investor in multiple startups. Currently, also run a IT training company, Tech July, and I have built a media management solution, J Gallery, which provide media solutions for iPhone, Mac, and Android. Like so, just to gain more understanding of customer behavior. Like I want to do something different, right? So a lot of insight there. with this, let me jump into what is a neobank, right? And how does neobank work? So to provide a basic insight, what is a neobank is like neobank is completely digital bank with no physical branches there. What is the core area is like in the current banking system, if you see, like there are multiple physical branches and there are expenses, right? So to run to lease a physical branch and then basically build all that, right? Infrastructure is not easy, but are we using that? So that's the question that has been there, right? And in last couple of years, by moving to mobile devices and using the digital channel, the thing is very clear, right? Most of the US customers are now going directly for uh, like digital channels. Like many of them haven't visited the physical branch for months, right? So the footstep or footfall into the branches is actually declining, right? So that's give to the birth of neobank. So with this, like, what is a neobank, right? It's operate exclusively online without traditional physical branch networks. This is a big change, right? So if there are no need of physical branches, right, where the most of the expense of any bank goes, like if you compare any big bank in US, right, uh, I will say like 50% of their employees are focused on operations within the physical branches, right? They are back office and other IT sectors, customer supports. There are a lot of things, right? But still, like there are a lot of engagement at the physical branches, and that is not just employees. Like we are putting money on providing the physical assets, right? And there are leases for multi years, like NNN triple N lease for the location and everything, and then you have to get the prime location, right? Now since many of these locations also provide the marketing opportunity for the banks, but since the thing is moving to digital marketing, will it make real sense to have a prime location in a city to get your brand value, right? That those things are in question, right, these days. So the key part is like as new banks, like why then new banks are providing that value. As new banks have no branches, the overheads are significantly lower, which reduce the overall fees. So I think that is the key part, right? If you see, if your expenses are lower, then you can pass those benefits to your customer. And in current day, like customer is always like demand conscious, so there is always high elasticity for customers to migrate, like where they see more value and less price. So although other banks are also doing that, current banks are also moving into more and more digital features, but it will take them a lot of effort and time, right, to change their operations. And that's why if something is starting from scratch, like you are building these neo banks where we have everything completely digitalized, it changed that complete mindset of customer, right? They're not even expecting to go to a physical branch, right? They're not expecting to go to access some of the things which are there in physical branches, right? So let's say if you have a locker or a safe deposit, right? So safe deposit box, you are not offering as a digital branch, you can't, right? So those expectations are different, right, with a new bank. But then you are looking for a better customer experience. You don't have to wait for a long IVR call or something, that you need to get a faster response online, right? Those are the things that are drastically changing. Much of the banking apps are cookie cutter solution, right? So if you see like one banking, the other banking will be very similar. And the if you compare that with other like solutions coming, or like other areas where you go to Google or Amazon or like whatever the product they are building, right, the customer experience is not that good. It's getting better, right? Over last 10 years, like it's much better compared to what it was, but still not equivalent to what the Silicon Valley companies are providing. So there's a huge opportunity there. Then how actually neobank work, right? So basically we partner with traditional banks to federally insure customer deposits, right? So there will be some customer deposits. So we have to use a traditional bank to provide that value. So what a neobank is doing, they are providing a best customer experience using digital channels and using a traditional bank, which just become a backend for a neobank. And all the money that is deposited in the neobank is secure. Like we use the FDIC insurance, so it provide all the security. Although the bank is no physical location, is branches are there, but then it has a corporate headquarter, right? Everything. It may have a IT development center, right, but not the physical branches. So that is one of the key area which is different between a neobank and a traditional banking. Now, what is and how AI is used in neobank? So the biggest area here is fraud detection, and like this is a burning topic these days. Cybersecurity is huge, right? Um, we have to basically depend a lot on our technology to find those frauds, and there is no doubt AI is the only solution for that. KYC verification, again, a lot of AI use. Customer service, like these days, if you have to provide a best customer service, you have to depend on AI. There's no other alternative. So now, fraud. When we talk about fraud, it's not a simple term, right? It's like when you go into detail of it, like there are a lot of complexities. So there are multiple type of frauds also, right? There are first party fraud, second party fraud, and third party fraud. Because I'm not going into this detail because the AI solution also different what type of fraud you are to prevent, right? So first party fraud is like where your customer is a bad actor, like they are trying to uh, basically try to provide the information, like they provide that information, but there is some issue with that, right? So the person, your customer, is directly, like the person is providing that information with the wrong intention. So there are different solutions how to catch that kind of behavior, right? Second party fraud is like you use, right, you attain information of a person, right, and then utilize that. Like the person is known that his information is there with somebody, and that bad actor is utilizing that information of uh, the first party to do a fraud. So basically, let's say there are some websites and these like they collect the data, like they're providing those kind of clickbaits, like somebody provide the information like voluntary, right? So I'm providing my information, and this bad actor is utilizing my information to to do the fraud, right? So there are different solutions for that. Third party fraud is there are some like vulnerabilities in our computers in which like the data got leaked, and then there are data aggregators which are again a bad actor. They are collecting all that information. So I haven't provided my information, right, voluntarily. Somebody capture that information and then use that. So there are different solutions, because what happen is when the third party or the person who is a bad actor is using somebody's as information, the type of AI that is used is different, right? So we have like we again at neobank, we are not AI expert, we are, but what we do is like we have to find the right AI partner, the vendors or the companies which are working in this area for decades have built fantastic solutions which can provide you like and detect all these three type of fraud. um, then you have transaction monitoring, right? So basically, like if a customer is there and this person is doing some kind of money laundering based on the transaction that are continuously happening, right? There are software which can basically find those patterns and create alerts, right? So you have to have a compliance team and fraud monitoring team in neobank, especially when you are never seeing those people, right? The challenge is bigger for neobank because there is no personal interaction, right? You will not see that person physically. There is a rapport building that happen when you actually see a person which is missing in a neobank. So it's not always a good right, there are some shortcomings, but then technology provide improvement, right? And now we are going into metaverse, right? Maybe like we have neobanks there, right, where you can interacting with people like virtually in metaverse. So all those are futuristic, but definitely there are opportunities in which you will still get to build that personal rapport. Now, with transaction monitoring and finding these patterns, like we have opportunity to act when something goes wrong, right? So there are ways in which you can find those patterns and then create alerts for the departments like fraud and compliance, and they can block the person. But then they are better, like there are predictive analytics in which you can predict that this person is traveling and he is the transaction that is happening or the transaction is coming from different area location, right? So it automatically can block that or cancel that transaction and send alert to that person. So those technologies are also there and heavily used in banking, and all these are like based on AI or expert system, right? So basically they are rule based expert systems to find out the abnormal user behaviors, right? Now the key part that AI tried to do is like, and what has changed in last 10 years is like earlier what happened is when we create these expert system, uh, the compliance team provide those rules, so they have to manually think and um, uh, basically say like, okay, if the area code is not matching or some uh, type of the merchant are completely different, or like it's coming from a gaming or gambling, all right, and this person is not that kind of person, then okay, block those transactions. But using AI you can actually detect and categorize those kind of rules automatically, and this will expose lot more rules and basically different type of action that you have to take. So it will basically enhance your capability as bank, not just to block everything but just to create different level of I will say monitoring, right? So for each action you see a person, you don't want to just block the card, right? You will just create, let's say, level 1 alert, level 2 alert, and then if some pattern is continuously happening, right, maybe you can predict those patterns and then stop those transactions, right? So those are the areas where like AI is definitely providing a lot of value. um, Other big area is KYC. So with KYC verification, right, there are multiple solutions available by fintech vendors, and all are good. Like they are definitely some outperformers, and solutions are coming with different flavors, right? So your on it depend on your onboarding process, how that vendor fit into your ecosystem. Now, they all provide the basic concept of risk signals, right? So basically, based on the email, phone, and address and device that they are using, different risk signals are created, and then either you do a manual or you do a AI-based approval or rejection process, right? So those are the areas like where AI provide, because if you are doing a high scale, when and this is very critical, right? Because if you put people, then you have to basically your scaling will not be that big, right? If you are having a huge investment on your compliance and fraud team to do this risk analysis for each and every KYC that is done, right, the scaling will not be that easy. And these days, like that's the key, like how fast you can deliver, right? So AI provide that value, like it can provide you auto approvals, auto rejection, and then sometime in some cases where AI is not confident, they can provide kind of a manual review, right? So all this need to be like AI investment just justify that part. There are new technologies coming in which face match happen, right? Facial biometrics technology is used to basically if a person face the device capture the face and then matches that with the document that they provide. So if they are providing a driving license, although there's not pretty pictures coming from the driving license, it's one of you don't want to show that, right, in your portfolio, not in your Facebook, but still the technology is have the capability to match similar face, right, even if it's not exactly what it's coming there. So that much enhancement is there in AI. So basically, identity verification from your proof of address, right? So basically, whatever document you are providing, now the government documents are also getting smart, right? They have RFID chips there. So there are technology coming in which they can capture more and more information, right? Not just information, but verified information from the customer, and then do the verification process. And to achieve all that, there is a custodian of data, right, from multiple database. Some of them are private and basically IPs there, and there are some public government databases also. So there are data aggregators which are actually capturing a lot of data from different sources, and then basically providing that data custodian. Now, this is one of my favorite, right? Because this is growing very fast, and I've seen a lot of vendors providing awesome solutions for our customer service. So, conversational AI is to assist the customer, right? And it is there for some time, but over a period of time, this is one of the key interests of many big, large organizations. Like multiple organizations are focused on this, how to provide the best conversation, right? So multiple solutions are there, and many of them are just plug and play. Like you have to just put a JavaScript in your application, or there will be a SDK that you can put in your mobile application, and it will start providing immediate results. um, and they are specialized basically bots. So basically, you can train the bots on different areas. You can train them for customer onboarding, then you can train them for any financial statements, or you can train them, and then the key part is like this training is not easy because it takes a lot of data and then a lot of improvement, right? A lot of testing of those bots. So then you can create frameworks, enterprise wide frameworks, which will, like, there will be a host bot which will transfer the queries like coming from different customer and transfer them to specialized bots, right? So this is something that is growing, right? I've seen like now it's like you are talking to a real person with real skills, and you will see that that there's no difference between a bot and a person, right? Other cool thing that I have seen is like bot with co-browsing. So if somebody person is stuck like where to go in your website or your mobile application, then the browser that bot will co-browse with you and take you to the point where you want to actually go and see that functionality, right? So it will be very similar human experience, right? So with that, I think I have taken like few minutes extra, but just
Yes,
want to
one question, Himanshu, for you. Can neobanks surpass banks and become our go-to medium of preference for financial transactions? By Mark. Question is by Mark.
right. So I will say like it may happen, right? But you know the future, nobody can define the future, right? It's only that you have to wait and see. But there's a huge basically migration happening, right? And it may happen that one of like most of our traditional bank become a new bank, right? So these banks are also working to acquire new banks. And they may go into that direction also.
Thank you. Thank you, Himanshu. Thank you for the thank you for the answer for the question. Hope it is got answered. There's another question. Okay. How much we have to deal with the trust factor with respect to customers?
Right, right. So it's a burning topic, right? Because you know, like if you are not seeing somebody, right, the trust is not there, and that is a human factor, right? So AI is actually doing more and more there, right? So right now, what we are doing, we are capturing the face, and based on that, we can understand the customer. We are also thinking to capture the voice, right? Based on their voice matching, their face matching, their gesture matching. So we are getting more and more information, and you see, like AI is not just growing in banking; it's also growing in your travel industry, right? So I was working with another vendor. What they do, like they put a camera in the car that will see how the driver is facing. Like if the driver is facing any kind of anxiety, or like the driver is happy, and based on that, like they will provide that feedback, right? So if there's a cab driven car, and the driver is not happy, so there will be some risk for the customer sitting, right? So those are the areas in which AI is growing, and these business model or these AI models will be used in different solutioning. So in future, when you will have those AI models which are perfected over a period of time and a lot of data, then definitely there will be much more trust building happening using AI, not just because right now we have to provide a verbal conversation, like we have to follow, we have to build a huge customer support team to interact with our customers. But in future, AI will definitely provide a lot of efficiency and help there.
There's a last question, Steve, by Steve, Himanshu, to you. There are fraud solutions being developed that look at how you hold your phone, how you
Mhm.
normally swipe, which finger you use, etc., all developing an AI model. So I think this is a comment from him. Yeah.
Yeah, they are there. We have used it. So in my past organization, actually, we have used a solution which capture all that information, how you are typing, right? It's kind of weird, right? Because you are actually going into too much privacy of a person, but at the same time, like there are a lot of frauds, right? I'm telling you, like most of the big banks lose a lot of their money in frauds, and if they want to get security, and it's the thing is, like cybersecurity is the burning topic, like it's not going to go down, it's going to go up. So if you have to be in business, you have to go and capture this information. There's no other alternate.
Thank you very much. Thank you for bringing this burning topic, which I
Sure.
know is an exciting one, and there can be a lot of time for this. But thank you for your time. We'll quickly move on to our next presenter, keeping in tune with the time. Thank you.
Sure.
So we have James Cowell, who's the Vice President of Credit Octane. His topic is MLAI in blending and credit analytics. So over to you, James.
All right. First, thanks everyone for joining us today. And my topic, let me just share first.
Yeah.
Can everyone, is my slide visible?
You just have to go to that slide, James. Yeah.
All right.
Now it is visible.
Just want to make sure, hey, screen is a little bit weird from my side.
Yeah.
All right.
Visible.
Cool. So first, right, and the guests have been talking about the AI in the financial industry, and my topic will be more around the lending, which is a, relatively speaking, more regulated, and I'm going to cover a few areas and share my kind of humble opinions and humble observations, right? And in my past 20 years in this industry. And I'm going to cover a few different projects, right? And from four kind of different areas, right? Why the machine learning, right, in lending? What are the enablers, right? And make the machine learning more profitable, right, nowadays than 10 years ago. And the second, I'm going to cover a little bit more on, hey, what are the major applications, right, of machine learning AI in the area of lending? And the third one will be, hey, what are those components of machine learning lending, right, machine learning, right, in the lending, and what are the unique challenges, right, the lending industry is facing, especially from the consumer lending perspective. And if you think about the machine learning, right, in lending, and what has been the enabler, right, for the machine learning, right, and to be more and more important and proliferate, right, in this industry. If we think about the traditional, the credit models versus machine learning models, right, the traditional credit models work very well, right? And for those prime borrowers, the borrowers with the high FICO score, and it had been there. If you think about the traditional lending, right, the brick mortar, and the credit unions, large banks, they have been primarily lending to the prime customers because they know, right? And these customers have very, very long credit history and tons of data from the credit bureau, and which makes, right, these lenders, right, can assess their risk, right, relatively easy, relatively accurate. However, right, if we think about the access to credit, who are lacking the access to credit, and the customers who are, right, and who do not have, right, much credit history, who are in a lot of cases are even so-called credit invisible. Right? If you look at some studies we have seen before, right, and CFPB actually was estimating 1 in 6, 1 in 10, I think 1 in 10, right, adults in the United States, right, are so-called credit invisible. Credit invisible. They do not have access to the affordable credit. And this is where, right, and the places the relationship, right, between the credit bureau score and or credit bureau data and the actual creditworthiness of the individual is less linear, more chaotic. And that is where the fintech firms have been stepping in, right, and to look at different, right, and models and to provide more access, right, to this type of customers. So if you think about the underwriting machine learning model, right, and what is the purpose, right, what we are really doing here? We are really looking to, right, to predict, right, the true risk of a loan, right, and if a lender, right, can more accurately predict the true risk of loan, the lender can achieve two things, right? It's either lender can approve more loans and that would otherwise not be profitable, and so that actually more, right, more borrowers can get access to credit, or the lender can offer, right, more competitive rates, right, to lower the cost of the borrower, and which at the same time can improve the profitability, right, the profitability of the lender, right, and the economics as well. So if you think about this scenario, right, and if you look at the non-prime or look at the subprime, what are the general default rate, the headline default rate? I'd say it's 20%. And what does that mean? It actually means there are 80% of them would pay back the loan, right? Would pay back the loan. So the question is, if you just look at the 20% default rate, you will not do business because it will make the economics not profitable at all. However, the machine learning, right, the algorithm, the available of more and more data, right, allow the lender, allow the fintech firms, right, and to identify, right, which part, right, of the 80%, right, more accurately. And another way to think about this is, and in a lot of cases, and if, right, you have, right, if you have, right, more powerful machine learning models, and then you can offer, right, and the credit, right, to the group of customers who are perceived as higher risk, but in reality, you can kind of carve out, right, those with much lower risk, right, so that you can offer, you can achieve two goals, right, at the same time, right, more credit, right, to those, right, and credit invisible or have limited access to credit population. At the same time, the lender will be able to achieve much stronger, right, economics and build up the competitive advantage, right, and in the lending space. And another thing that has been enabling, right, the machine learning, right, in the past few years is the increasing computing power, right? The powerful machine learning algorithm, right, need, right, the computing power to make the real-time decisions, and so that, right, and the customer have the seamless operational process. And in a lot of cases, multiple models have to be run at the same time. The increasing computing power actually makes that, right, make that feasible, right, nowadays than what was in the past. Last but not least here, right, if we think about the lending industry, especially consumer lending industry itself, it is heavily regulated, right, industry. And when you have a machine learning model and you look at thousands or hundreds of variables, right, and to spill out, right, outcome, who is higher risk, who is lower risk, you got to summarize that into, right, a few and accurate, right, adverse action variables, right, to tell, right, what are the major reasons that are driving your underwriting decision here. And in the past, it had been fairly a black box, and machine learning model, it was the hardest thing to do, and the regulators were not embracing that either, right? However, with the machine learning model, the interpretability, right, the explainability of the model have improved in a great deal. As a matter of fact, right, and CFPB has issued some blogs, posts, and has been encouraging lenders, right, and to develop, right, that in the kind of innovative solutions, right, so that, right, to increase the fairness and to increase, right, and the access, right, and to credit for those largely either underserved or invisible, right, population. So those are, if you think about, those are the general enabler, right, of the of the lending industry, right, to take machine learning, right, to a, I would say, much day than it would in the past. Given the time, right, I will be, talk a little bit faster. And the second thing I want to cover quickly would be the applications of machine learning in consumer lending. Commercial has been covered about AI, right, in customer service, in fraud, in KYC, and if you look at in consumer lending, the three different areas, right, that I can think about in terms of application. And if you think about from the customer life cycle perspective, the first, of course, will be the targeting, right, the getting the customer through the door, right, finding the customers who want your lending products and also are suitable for the specific products you are going to offer. And this is where, right, the lenders, right, are looking more, right, specific ways to drive down their customer acquisition costs, the CAC, right, and which, well, right, and basically who do I target, right, and what type of customer do I target, and in the message, in the channel I'm reaching out to the customer, right, do I use direct mail or do I use the email, right, and in the marketing campaign, what type of, right, marketing copies, creatives, right, should I use, right, to, right, target a specific segment of the prospect. All those things boil down, right, the sophisticated machine learning algorithm will help much better, right, and accuracy and targeted response, so that the lender can drive down their acquisition costs, and as a result, lender can have stronger economics and also lower, right, potentially the cost of borrowing as well. And move on to the second, if you look at the second step of the process, which is the underwriting, right, underwriting, where the key objective really are, one, assessing, right, the risk of default, right. Second is assessing, right, and in a lot of areas, the risk of misrepresentation, and most prominently, right, the misrepresentation of the income, right, of the employment history, that type of area too, right, if the lender, right, can, right, and assess the risk of default, right, and much better, and which means, again, right, and we can approve, right, by having the same default rate or lower the rate, right, for those we approve as well. And last is the life cycle management. If you think about life cycle management, once you have the customers, right, on board, right, with you, right, how do you, right, proactively monitoring the customer behavior change, and such as, hey, who do you predict will be delinquent, and who do you want to take cautious measures, right? And from collection strategy perspective, how do you, for credit card product, how do you manage the credit lines more dynamically, right? And to either, right, increase engagement for those customers who have been demonstrating the strong behavior, or, right, adjust down the credit line, right, to reduce the risk of a lender. And in terms of collection strategy, that is kind of one area, right? The machine learning has been, I would say, thriving in a way, and because there are many ways you can think about collection strategy, right? You think about collection strategy, and into how do you segment the customer, right, into customer who can self-cure, or high touch or low touch, and how do you, right, and use machine learning to design your contact strategy, right? Contact, here you have to think about the second order impact as well. That's where the machine learning, right, gave a lot of value. The second order, which is, if you think about, it's not necessary you contact more the customer, the higher the likelihood the customer will pay you back. And you may have second order, some customers get annoyed, right? How do you, like, get annoyed actually, right? Well, not pay you. And how do you, right, leverage all this, right, machine learning algorithm capture that type of nonlinear relationship, right, in your model, right, and in your practice. And I'll quickly go over this one, right? If you think about the components of machine learning model, right, and measuring 4 different areas, data quality, right? The data quality is the most prominent. If you think about your, right, machine learning model, the accuracy of your lending decision, actually the data quality is even more important than your algorithm itself. If you're, right, most of times the machine learning model is not stable, or the performance accuracy is not as good as expected, it's because of the data quality, right, or data, right, inconsistency between, right, how, right, you train your model versus how, right, the model is being put in the production. And out of this 4 quadrants, right, and the monitoring and feedback loop actually is very critical in machine learning, probably underappreciated a lot. And the reason is, if you think about lending space, and it takes time. It takes time, right, for the bad, right, for the target label, right, to show up, and because it takes time, right, for the account to mature. And another reason is lenders constantly make changes to their policy, to their strategies. Some strategy, let's say, as I mentioned, the collection strategy, a much more effective collection strategy will, in fact, actually reduce the target label, reduce the bad, right, in your data, which would be different from the data you use for the training. How to get that loop in, right? Constantly adjust and train your model, make it more effective. That actually is under, and that should be, right, and that's one of the observations I have, right, in the past. And given the time, I'll just conclude here, right? And in a nutshell, if you think about the lending space, and the machine learning itself, right? If you think about casual competition, right, you cannot just throw in, right, an algorithm into the lending industry and to make it work. You have to think about what is required regulatory and all those other, right, all those factors that are critical in the real, right, lending world. Right. Thanks for all, and apologize for being overtime here.
No, thank you, James. Thank you for the lovely presentation. Actually, you are on time. Thank you for the same. Thank you for coming as a great speaker in our event, and love to hear from you. So we'll quickly move on to our next things, which is a panel discussion. So may we have on all the panel members on stage, please? So before setting up for the stage for them, just need to let all of you know what is the panel discussion all about. So panel discussion, the topic is the outlook for a smart banking industry driven by AI. And we have 5 great speakers here. Harris Ikram is there, who's head of product management, mortgage products in the blend. Then we have Jacob, who is head of the model risk, Regions Bank. Then we have Ben Ross, who is the CEO of Green Payments. We have Aaron, who is advisor and investor Optimal Financial Systems. And last, we have Chitray, who is the CTIO of InfoVision, and he is the moderator for the event. Over to you, Chitray, please. Thank you.
Thanks. Are we missing one person?
Aaron Gitt. So let me
Gitt.
follow with him. We can start with this.
I don't see him. Yeah, perfect. Good morning, everyone. A quick introduction about me. I'm Chitray Mani, and I'm the Chief Technology and Innovation Officer from InfoVision and CEO of Digit7. Thank you so much for all of your time. Nice to meet you, Ben, Harris, Jacob, and others as well. Please, why can't you have a quick introduction about yourself just for a minute, all of you. Ben, start with.
Sure. Thank you, Chitra. So my name is Ben Ross. I'm the Chief Operating Officer of Green Payments. We're a merchant services and point of sale company. So at the end of the day, we help businesses and organizations of all types accept payment. A lot of our business has evolved a lot from just kind of that basic credit card terminal that would sit on a counter to now, a full point of sale system, fully integrated, with invoicing and all sorts of other billing tools and employee management and inventory management and all that kind of stuff. So, but I'm the Chief Operating Officer, oversee all of our support and sales and, submissions, underwriting, all of that. So I appreciate the time and ability to kind of talk on AI and how that's kind of helped streamline a lot of what we do, and definitely look forward to the discussion.
Thanks, Ben. Harish, you want to go for it next?
Yes. Hi, everyone. Pleasure to be here. I'm the VP of Product at Blend Labs. Blend Labs is a fintech company that provides software to banks, lenders, financial institutions, and fintechs. We provide software capabilities from origination all the way to close and title and insurance as well, across both mortgage and consumer banking as well. Super excited about the conversation today.
Absolutely. Thanks, Harish. Jacob, could you please?
Thank you for having me. My name is Jacob Kossoff. I'm the head of model risk and AI risk at Regions Bank. We are a super regional bank located in 15 states. And at Regions, we have a variety of models, credit models, underwriting models, fraud models, and so forth. And so what our team does is really manage the risks from those models and from those analytical approaches.
Absolutely. Thank you so much, Jacob. Nitin, can you move on? We're not waiting for him. Hope.
Yeah, we can move on. I'm just catching up with him. Once he joins, we'll have him. Yeah.
Sounds great. I think we are going to definitely have an important topic today. People always a buzzword. I think AI crossed the level of buzzword, right? So if you talk about decade before, AI is more kind of buzzword. Hey, everything AI, but now it's kind of mainstream. Everyone know about this. But still, there is a lot of the one domain, which is not, maybe two domain I can call manufacturing industry also. And banking industry is adapting to the AI, but the way the speed which is adapting, not like other industries. Think about retail, telecom. They are moving very fast in AI adoption in multiple, it may be omni-channel perspective, it may be personalization perspective, analytics perspective. Banking still adapted only in analytics side. So is there any particular reason why banking is moving a little bit slow in AI side, except some of the banks? I'm not calling all the banks, not like Capital One, but not all the banks are moving forward quickly. Is there any reason? Why do you feel?
This is Jacob. I can go first. So one is that whenever we have a traditional regression model, and that's already being used for a process, say collections or underwriting, and there's an AI model that's being presented, it has to perform better than the regression model for us to go live. And so what often we'll see is from vendors and internally developed models with more machine learning and saying, we understand there could be a little bit of a trade-off on explainability and interpretability, but with that trade-off, we need to see more predictive power. You need to get us comfortable that it's not overfitting. You need to get us comfortable it'll perform well in our footprint. You got to get us comfortable it'll predict well through the economic cycle. And so regardless of regulators, regardless of internal audit, regardless of explainability, regardless of interpretability, regardless of all those other items which matter, if fundamentally we believe we cannot be convinced that there's no lift, there's no evidence showing the machine learning models more predictive, there's no evidence showing that it can separate goods and bads better than the regression model. Without that, then all the other conversations don't even proceed forward until we see that there's actually predictive power. If you get through that first hurdle and say, okay, look, I've actually shown evidence that this can perform better than regression models, we can expand our credit box. Then we talk about, okay, let's talk about disparate impact. How are we with, does this model perform worse on protected classes? How are we with explainability? How are we with interpretability? So a firm like ours at Regions, we have a zero threshold. We have no appetite for black box models. We will not use any model unless we are 100% comfortable on the how and the why, on explainability and interpretability. And if we need to do things like, force monotonicity constraints on variables and so forth, we will. But we will not use a black box. We want to be able to explain to ourselves how this decision was made. And we understand if you go from a regression model that maybe has 20 variables to a machine learning model, which has 1,000 features. And if we say, okay, one of the features that might predict default is if somebody uses their ATM from 2 in the morning to 4 in the morning, is that something we're comfortable as our feature? Are we comfortable as a bank? Could that be a disparate impact against, healthcare workers or working in the middle of the night? Do we feel comfortable with that? If we can't get comfortable with that, we're not going to go live. And I think most banks aren't. Plus, there's obviously regulatory desires is there, but I think that's kind of second. I think the first is as a bank, as a company, as an institution, if we can't be comfortable with how we're making credit decisions, we're not going to go forward. Second, the biggest concern is systematizing discrimination. If in a more manual process you have errors or there's disparate impact, you can focus on that individual person who made that bad credit decision. If you replace that credit decision with an automated decision process, that can be wonderful. You can bring in more consistency. You can make it quicker. Maybe you can make it more accurate. But are there biases already built in your underwriting process? That is, you had historical biases which led to more, say, declines for certain populations, right? Now, if you're building a model off those past discrimination, those past biases into your model, you're going to have a forward-looking model that is going to predict that as well. So, the famous case is Amazon, which had a model designed to predict who got promoted. They wanted to predict who they should hire. They wanted a model to figure out who would be a good employee. So they took their entire database of existing employees and they tried to determine what characteristics would correlate with those that got promoted. So, of course, what got correlated? The biggest correlation to not be promoted is if you went to an all-women's college, right? So, and other variables that correlated with gender. So, of course, then when they use it for hiring, what would they run into? They'd run into a situation where the model would have a disparate impact or discriminate against female applicants because historically they had some biases built in. And that is one of the fundamental problems with whether you're building a marketing model in banking or a credit model in banking or a fraud model in banking is if you've had historical problems, are you now exacerbating that or at least systematizing that? And so I think that's where it gets us comfortable. So the regulators, yes, are important. Internal audit's important. Risk management's important. But fundamentally, more important than that is, as a bank, are you comfortable using these models? Do they perform better? And in many cases, we've seen that they have not. And so that's why we take some pause. And second, can we get comfortable on explainability and interpretability? And if we can, then we have zero appetite for any black box model used in any situation.
Sure, so we are not ready yet. So your point is you are not comfortable yet to say that yes, that's your point, Jacob. So what about others as well, Harish and Ben? What is your point of view?
I'll say a couple of things in addition to that. One is the technology curve for AI has kind of evolved as well, right? So if you look at things like the ability to W-2 is a very structured document, relatively simple to to kind of do OCR capabilities on. Now, a lot of tools can do this with 98% accuracy in terms of text extraction, even for W2. Several years ago, even 3 years ago, that was not possible. It was much, much lower. So one is the quality of the technology has improved sufficiently over the last couple of years. There's been an acceleration.
But the point is, we cannot wait for all the technology to be matured and implemented, right? You have to start embrace with the technology slowly, right? So, but then adoption will be slow rate, right?
That's right. So one is the technology has progressed. Number two, people have also kind of learned and understood that you cannot rely on AI to make all the decisions, right? So there's been a change in mindset. People have understood how to use AI. Like 3-4 years ago, I can say in the industry, it was a set it and forget it mindset. Like, can this be like my Tesla car? And like, it'll do everything for me, from, identifying which borrower or consumer to go after, all the way to making credit decisions, to signing off on a loan file. And now I think institutions have gotten a lot smarter about this. Exactly. And leveraging AI selectively, right, and having humans in the loop where needed. So, for example, if it's about loan fulfillment or conditions clearing or something like that, it's sure you can use AI to kind of go through all the rules and do the rule matching and clearing, but have a human review that information. So there's people have gotten a lot smarter about how to leverage AI and do it selectively and bring it inside the process versus trying to say, to Jacob's point, we're going to take this whole step out and put a black box solution in, right? So the people have gotten a lot smarter about that. So because of those two things, we see more adoption of AI technology across the board. And then, the last thing I'll call out is there's, I guess, when you are leveraging AI technologies, there's different level of risks and impact based off the use case, right? So if it's something like a chatbot solution that's top of the funnel for sales and marketing, it's pretty relatively low risk in terms of what impact it has on someone. When you are, maybe trying to do detect someone's government ID to do identification, if that goes wrong, you can have a human jump in and review their, their information. That's okay too. Now, when you're making credit decision, doing risk modeling, clearing loan files, that have a meaningful impact on the end consumer and the bank in terms of risk as well. So that's where you want to be more careful. So depending on the use case as well, AI is being deployed differently.
The bank don't want to play the numbers, the finance side of the people. That's what the very, very, very cautious on how to take steps. Makes sense. I like definitely Jacob and you, the way of depth you guys are going, why you don't want to move fast, because it's not ready. Makes sense. Ben,
I don't think that we don't want to go fast. I think we are happy to go fast, but often it's sometimes it's snake oil, right? We'll see a vendor who'll pitch an AI model and say, it's great. We use alternative data. Look, we use, we use cell phone payments. We use energy payments for customers. We use their apartment details. That'll help minority lending. And you look at it and it hurts minority lending. That if the gap between whites and non-whites on FICO score is here, well, gaps on utility payments are bigger. Gaps on rent payment is bigger. Gaps on cellular plan, on mobile phone payment plans are bigger. So when we see, for example, a vendor who'll come in and say, "Oh, our model's so amazing. We're using alternative data. We're using non-credit data. We're using rental payments. We're using other payments." That's going to close the gap and help you lend to more diverse customers. No, what happens? Sure, you end up lending to you can expand your box among lower income white individuals for sure. But that exacerbates the problem of approval rates between minorities and majorities, or minorities and majority. And so I think it's important that when a vendor would come in and saying, "Look at this, we use alternative data and this machine learning, it's going to improve." Show us, because every time we've looked, it actually exacerbates racial gaps in lending, especially apartment data and rental payment data. That, as an input into your model, expands the gapping between minority and non-minority approval.
But keep in mind, as a customer, I'm a consumer, right? So I'm a customer, which I would like to do more automation, more everything more.
No, you get declined more. You'll get declined more.
The process timing, everything is very important for us to reduce, right? So that's the view when I see that. Hey, yes, bank wants to take in a very cautious steps on approving cash-based information.
The customer, I think, doesn't. I think what you're going to have with the expansion of AI is more minorities will be declined credit. So I think it's going to be a bad situation in many of these where we see it right now. So say you're a 681 FICO score, but you've missed some non-credit payments. You've missed some cell phone payments. You've missed an electricity bill payment. You've missed a gas bill payment. You've missed, whatever it might be, your apartment. But your credit payments are good. You're at 681. And the cutoff, we use FICO, 680, boom. So you're approved. If you introduce alternative credit, what is happening today in modeling in 2022 in the financial services sector today is those customers, because they're more likely to have missed other payments, that's 681, instead of being approved, they are now going to be declined. And so what we've seen is that the introduction of alternative data today is leading to more minorities getting declined.
I hate AI. Don't worry. I hate AI.
Oh, no. I'm just saying.
Now I hate it. Now I understand.
No, there's just risks. There's risks and benefits. There's both. Go ahead.
Yeah. Hey, Jacob.
Thanks.
Jacob. A question. Yep. That results, is that surprising to you? Right? As a matter of fact, if more minorities are being declined?
I think as a society, if we send a message that if you have two bills to pay, you have your rent and you have your mortgage. If some groups here, if you only have two to pay, you should pay if you have your car loan and your rent. Let's say your car loan and your rent are your only two payments in your life. Just make it simple. Car loan and rent. And you're struggling financially, and you should only pay one. You can only pay one. You say, okay, fine, I'm going to pay my car loan, I'm going to miss my rent, right? If historically other credit provisions, when the person goes to get one day a mortgage or one day to get a credit card, if historically you've only used the car payment in their models, you're going to have one outcome. Then if all of a sudden we're going to use their car payment history and their rental payment history. So I think as a society, you really have to step back and say, when someone's in a financially difficult spot and they have two bills, a credit bill, credit card, auto loan, whatever it might be, student loan, and they have a non-credit item, a cell phone plan, heat, natural gas, water, whatever it is. If we're encouraging populations to pay one over the other, and then the switch on what's included for credit scoring and what's included for the future allocation of credit for that individual changes, then I think it's important to then communicate to these individuals that what we care about as a society or what we care about in the approval and allocation of credit has changed. And so I think we're putting ourselves in a bad spot if all of a sudden we say the most important thing is to hit anything that's a loan. Always pay your credit card over your rent. Always pay your auto loan over your heat. Always do that. And that's what you're saying year after year, decade after decade. And now all of a sudden you say, oh, never mind. For future credit, we're changing it around. Your apartment and your utilities and your cell phone payment and your other bills are going to matter more. Well, then I feel like you're tricking people from a society point of view. So I think it's just important how we message this to potential.
I'm going to change the topic to a little bit positive side of the banking in AI as well now. Okay, so I think we got a depth of information. I think hope James Jacob answered your question.
Yeah, it does. But I want to kind of present the opposite scenario, right? I think the way, right, the initial purpose of introducing like rent payment others are more on the, I would say, so-called positive side, right? And because for those guys, right, they are, right, and today they are more likely of lacking, right, additional so-called positive, right, and enablers to be included in the model. So yeah, I mean, Jacob, I totally agree with you on the scenario you are talking about, but the opposite scenario, that impact might be, right, and let's say
for
impact
thin files,
more.
Yeah, I agree. Yeah. For thin files, yes. For those that have a thin credit history, I hear you. Yeah.
For time perspective, let me move on to the question.
Good discussion.
Okay, let's get into this. What is the future of AI in banking? Ben, would you like to start? What are the future you see in the banking?
Yes, so I'm on the payment side of things, but in our world, a big part of it is on the risk side and underwriting, being able to review, and get deals approved, not deal with funds being held as much. And also even for us, when it comes to the proposal side of things, in reviewing statements and confirming, okay, look, what do the numbers look like? How quickly can we turn around a statement and get it out? That's a big part for us. So I think, to me, when it comes to looking forward on it, there's going to be a ton more of, whether it be different software platforms or just different systems that are put in place that don't obviously remove the human element. Going back to, I think, something Jacob was saying before, the human element's very important because, we don't want to make all decisions simply based off of some sort of algorithm that's
But
put in place.
but the problem is you are talking about the payment, but think about fraud, right? A lot of fraud will
Correct.
get into picture. The AI is going to be a major player into, because we cannot expect the human to review and approve all the stuff, because a lot of payment companies are bringing more AI based fraud detection system. Even Himanshu talked about it. So, but what do you feel? That is like that component will improve the payment in the future. AI will help a lot, or still you see human is the major role?
I think it's a combination. I think the AI is kind of the benchmark, and then the human comes in and makes the kind of the quick final review. And if it's under a certain threshold, which is how we kind of handle it currently, it's under a certain threshold, then the AI is kind of operate. The system's operating on its own. But once it hits a certain threshold, then a human needs to be involved because there's too much. I mean, as a very simple example, right? Just the other day we had one. And it's a flooring company, so not a massive company, small company, but they have certain bin numbers, right? The cards matched, and it was 5 or 10 transactions that all had the same, or a very similar bank that was where the cards were from. So of course the system caught it, but but then once it was reviewed, it's pushed right through because at the end of the day, it's a Chase credit card, right? I mean, plenty of people have them, so it's yes, was it a high percentage in that business? Of course. But at the end of the day, that's where, the way I see it. I personally think, and I agree with you on the fraud side that it's super important, but there's still got to be that human review on top of it.
Sure. Let me get into one more question on especially the mitigation of AI risk. This is one of the important areas. We are talking about all AI. So, how is your firm developing guardrails to mitigate AI risk? Jacob, do you like to take it?
No, that's a great question. And also, I'll put a link in the chat for anyone who wants to look at some materials later. I think it's important for the line of business, any developers, and the risk management teams to really sit down and figure out what is our approach. We don't want risk management to be the death of innovation. We don't want to be slowing down model development. And so I think it's important to step back and say, what are we looking for in our analytical processes? How are we going to do ongoing monitoring? How are we going to test the models that it's, say, underwriting models, that it's performing well? How do we agree on back testing? How do we agree on ongoing monitoring by segments? How do we agree to test the models for disparate impact? How do we agree on transparency? So I think it's really sitting down and walking through those questions. So I'll take a simple example on predicting default. There's a variable, length of credit history, length of deposit history, even better. Length of deposit history, such a tricky variable. Generally, for the first 30 years, every year of deposit history means you default less. It's correlated with less default. So somebody with 10 years of deposit history defaults less than 9 years. Once you hit around 30 years, the sign changes. Somebody with 38 years of credit history, deposit history, having a checking account, 38 years of deposit history defaults more than 37 years, and 39 defaults more than 38. Now, these are edge cases, so we have to be factoring that. But so what's going on? I mean, mainly what's going on is people die and then they don't pay back their credit. Their estate doesn't pay back their credit. But so now you have a variable that on the face of it, for 90% of situations, a longer deposit history is correlated with less default. But for 10% of customers, roughly, larger deposit history for that segment is correlated with more default. And so when you think through, say, an example of your AI guardrails, do you force monotonicity? Do you force this to be linear? And that's just one example, but really thinking through, are you going to have a compliance review of every variable? Are you going to challenge every variable to find a disparate impact? So, for example, there was discussion on income. Say somebody applies for a loan, they make $100 a week in income, and it's Social Security disability income. Do you just say it's $100 in income, or do you force the model developers to gross up that income to count as 106, and then it's more predictive, but it's also more predictive and has a beneficial impact on protected classes? So it's really setting up those conversations. Do you have to review every feature? Do you have to do things like gross up variables? Do you have to have logical business connection with every variable? So it's really starts with those conversations throughout the bank.
Beautiful detailed explanation, Jacob. Really nicely you covered the example well. So let me go into that. Is there anyone, Harish or Ben, do you want to take that question as well? How to guardrail the mitigation of AI risk? Any points?
This is Ben. I think something that we touched on before, and I'll add to it from our end, is really making sure that that the parameters that are set truly protect both, the company and kind of the bank side, but also protect the merchants, right? Because a big part of what we're looking to protect from a risk perspective is fraud. The merchant doesn't even realize their account was stolen, or maybe even their identity was stolen and a fraudulent account was opened up. I mean, things like that are really what's super important. And so, obviously every situation has its own threshold that's set, but making sure those are in place and making sure that those are monitored. And it's not just, let's just let things fly and go. I think it's super important because it's there to protect, the system and the bank, but also really there to protect the merchant, the consumers, right, whose cards are potentially stolen. I mean, there's so many layers of it. And that's, I think, something that's super important to us.
Great point, Ben, definitely.
Yeah, and
So
I can add
sorry, go ahead, Ramesh.
I was going to say I can add to that from a software development perspective, in the sense that as folks developing software that might use AI, the objective isn't to use AI for the sake of using AI. It's about thinking about the end user problem, what our customers and our customers' customers want to do, and working backwards. Right? If AI is going to help, then great, and if it's not, then it's not necessary. Same thing with blockchain or these other things. Like, you don't always need a decentralized ledger for everything. You have distributed databases that can solve a lot of those use cases as well. So it's really thinking about the end use case. That's one. Number two, also about as you develop this, I think Jacob touched on it. It's like testing it, deploying the model, iterating on it, working through that. And sometimes that can mean when you deploy at a customer, you have to soak in a lot of data for a while, because you have to train on a per customer to customer basis as well, right? So it's not one single kind of solution that just works in production from day one. So like sometimes there's work and training that has to happen behind the scenes. And the last thing that I said before as well was, again, since it's tied to use case, having humans in the loop may often make sense as well, and that's okay too.
Sure. So let me move on to the next other question as well. Nicely answered by everyone. And how can AI drive productivity, improve time or cost for processing loans? Harish, do you like to take this question?
Sure. I think there's a ton of application across the life cycle of a loan, right? Like if I just use mortgage as an example, when it's top of the funnel, sales and marketing, you can use capabilities like chatbot, have more personalized experiences using AI for the end consumer, surface some of the right types of product options. That'll just make the whole process go faster and require less loan team involvement as well, potentially, right? So it's more productivity both for the end consumer and more productivity for loan teams. That's one. As you are going through origination or going through fulfillment, you can do like leverage capabilities like OCR technology, or automate some parts of the conditions clearing, et cetera, as well. So there's a ton of things you can do there that'll remove or reduce rather some of the manual work that people have to do, right? It's never fun going through so many different documents and files, and some of this information can easily be reviewed using software and AI, and you could automatically maybe trigger an email or a workflow. That saves time and money for the loan officers, for the loan teams, so that they're more productive and they can focus on the less menial tasks, the really important things like building relationships with their end consumers and all of that. So I think there's a ton of opportunity across the life cycle a financial
So
product.
I don't know whether Jacob is agreeing with that or not, because Hari's statement is very clearly it is improving time and cost to process the loan. Okay, so will that helpful? Still, AI is bringing a big player to helping you and as well as your consumer, Jacob.
Well, I think there's a difference between AI and then just like robotic process automation. So there's different things, right? When we're using,
More models. You are more model driven than automation. You're talking about,
right?
no?
So it's different
But
things. So
still, end of
you
the
can
day,
manual process. What?
the end of the day, but still some more model driven predictive analytics is more different than automation process. Understand? Okay, but
That's right.
still,
That's right.
yeah, but still, my point of view. End of the day, think about OCR. It comes with more deep learning experience nowadays. It detect whatever data in the pages, reading it, and improving the process more.
Right.
But still, it's a process to improve it more, right? It may be
Exactly.
collaborating in the future, but definitely, I see the point. Automation process helps you a lot. The model is still not there. I agree. Yeah, I get your point, Jacob. Thanks, Harish as well. And okay, one of the important area: how can AI lead to better end consumer experience? Who would like to take it, Ben?
Sure. I think for us, when it comes to the consumer side of it, we look at our business, there's kind of multiple sets of consumers, right? There's our agents and kind of our partners that are out there that are a sales force that are driving deals, and they're a customer in one way. There's obviously then our merchants who have, their business, and, there's the other things there. I think for us, when it comes to how it improves the day-to-day for our agents, is it avoids a lot of the roadblocks that wouldn't need to be there otherwise, right? So when it comes to the statement analysis and the review of proposals and developing kind of, setting out, okay, what should this deal look like? And now you go forward and get the deal done. It improves the speed from, we get the statement, let's review it, and now let's get back to the merchant, try to get the deal done. It improves that drastically. And then and so obviously that is a positive there. And then on the risk side and the stuff we were talking about earlier, when it comes to protecting against fraud and fraudulent accounts, that's obviously a huge win that helps our, merchants and helps also our agents as well, protect them from, getting into weird situations. But more importantly, it helps our merchants to make sure that, their identity is not stolen, or, there's not, fraudulent transactions run and things like that.
How about Harish on the consumer experience? Thanks, Ben.
Sure.
Yeah, Chitra, what's the question there? Do you mind repeating it?
How can AI lead to better end consumer experience?
Oh, sure. Yes. A bunch of different things, right? So if you think about the end consumer, one, I touched on some of these examples. Instead of, reaching out to a human and then waiting a couple of hours to get a response from the loan team, maybe you have capabilities like chatbot that can automatically answer your questions, or more advanced searching capabilities that are powered by AI, that help you get answers. So that's one, right? Other things could be, when you upload your document, then there's many workflows out there you see where people have to upload their documents and then type all the same information all over again. Why can that not, automatically populate the forms and fields so the end consumer can just review? That just makes it a much faster and better experience. Once that information is in the system, can that flow freely? So why is there a silo between data if it's a home refi or a cash out refi or different financial products within the same financial institution? Can you kind of pool some of this data and use it across multiple products and use cases, so that for the same consumer that's going to the same bank or lender for many financial products, they can hopefully reuse or utilize some of their data, especially if it's more fresh and relevant, right? So there's ability to do cross-sell, upsell, provide more proactive financial products, etc. So there's a ton of opportunity from that perspective too for the consumer.
Sure. How about Jacob? What is your view on the AI and the better consumer experience?
Yeah, I think yes. I think there's a few different things. So one is on those kind of customer interfaces, and I guess, do you call it AI? Do you not? So I think there's definitely going to be a lot more automated processes, a lot more manual processes. A lot less manual processes, right? You're going to be going to the branch less. You're going to be, things are going to be done a lot more in a touchless environment. And so, as Harris was mentioning, right, instead of having to copy from one document to another, there's OCR that can pull it from text. And we do that here. When we had to update contracts for LIBOR, we didn't go through every single contract with our eyeballs. We used OCR to pull off every contract where the reference rate was LIBOR. And so I think it's the same thing if we're working with Freddie or Fannie. We have to go back every loan we sold them, document review. So I think on the consumer side, it's good. You're going to see more automation. I think automation is going to grow dramatically. I think AI is going to grow, and I think it's going to make the customer experience overall better. I think where the risk is actually on these, on not the majority of applicants, but on a subset where the decision that is made is going to be a decision that's not as good. So maybe the customers are going to get quicker decisions. Are they going to get decisions they like? I don't know. But, so, it's like when you call, before you'd call and you want to talk to somebody on the phone at the airline for an hour, and then finally you'd get the decision. All right, fine, we'll change your flight for free. Is that better than you use an app and says, your flight's not changed, it's $500. So right away, your flight's not getting changed. It cost you money. Versus so you're going to get quicker decisioning. We're going to get quicker decisioning on underwriting, quicker decision on collection strategies, quicker decisions on line assignment, quicker decisions on payments, quicker decisions on this is fraud or not. But the trade-off could be, I'm not saying it is, but the trade-off could be the associate the person, the customer, might not like that decision when they're declined quicker. So I think you're going to get it quicker, but you might not like your answer.
It's pros and cons, both. I get it. I don't know whether you are a pro AI or you are against AI. I'm still not clear.
No, I'm realistic. I'm just trying to be honest and realistic. There's many benefits, there's many costs. I'm just trying to be practical, rational, reasonable.
No, I get it. Just so let me get into that more on. How do you see the call center experience? Because the AI is booming in a lot in how to give a good experience to the customer when they have questions or how to solve their problem instead of humans getting involved in more, right? This is both model of RPA as well as you talk about models, both play in the call center experience to bring the data back to the customer. Hey, this is to answer it, right? So what do you see? What is the next generation of call center experience for the consumer of banking people? Who would like to take it?
Yeah, I can take a first stab at it and welcome conversation from the group. If you look at call center experiences outside of financial sector, like AI is being used in a number of different ways, right? Like, so some examples are...
Let me think the way, maybe instead of call center, the word AI agent, okay? Every banking sector has an agent which is clarifying the customer questions. So let me use the word AI agent instead of call center. Yeah, please go ahead.
Sure. Yeah. In the case of the agent, some of the things that we're seeing are it's less about agent replacement and it's more about agent assisting, right? Like where can AI capabilities assist the agent? So some of this again exists in other sectors as well and is being used, right? So like things like lead scoring or opportunity management or call flagging, end consumer that's at risk or is about to churn or any of these things. So a lot of that, those have been used in other sectors for years. And so banking is using that more and more. But I think there's just a lot more opportunity to kind of adopt these tools to, one, make the agent smarter, assist them, help them make decisions, help them prioritize route tickets and issues so that they can, always try to best serve their customers in the most urgent needs as well. So there's that's one example of where there's opportunity here.
Sure. Ben or Jacob, anyone?
I agree. I think that makes sense. It assists the agents. It's not always going to replicate the agent where, I think for simpler decisions, not just simpler, for a growing set of decisions, yes, it'll be automating it. I think where a customer will have a frustrating experience is when they want to talk to a human and there's a smaller and smaller set of opportunities to talk to the human. For customers, that could be a frustrating experience, and they might then switch to the competitor who gives you a quicker access to a human. And so if someone's in this loop where they can't get out of this auto decision process, it could be quite frustrating. You could lose some consumers. So I think banks are just trying to balance that with also reducing, labor costs. So
Makes sense. Ben, any part of
Yeah,
yours?
no, I'll just echo that. I think, from kind of my day-to-day perspective and how we approach things, we try to leave kind of the AI and the automation side of things on the back end so that it's not so, customer or merchant or agent facing, right? And leave the people to be the front line, to build the relationships and have that real kind of emotional and that real interaction. So while when it comes to updating address changes and things like that, it can be done. It's not something that we've fully executed. I think industry wide it is something that's happening more, but I agree with Jacob that I think where the downsides come in is very quickly people get annoyed by it, and when if someone's calling in today's world, they have a question, it's a conversation that's needed. It's not a simple answer. If it's a simple, I want to change something on an account, or I want to update something, or I want to dig in and get an answer on something very simple, they're typically going online for that, right? They're not picking up the phone and calling. So in my view and the way we approach it, and even from kind of an industry-wide perspective, I think generally speaking, that's just how it is. I think the phone side of it, is where the human interaction happens.
Okay. So thanks for all of you. Nicely, you guys all deeply given information. So one quick information we need from each one. Take one example, a real-time example, what you have faced in your career on the A risk, something which you felt, hey, there is some risk which I don't want to go. There is going to be some problem. Have you felt any risk which you backed out implementing that one? Any one of you?
So I'd say on our fraud models, we, go back 3 years ago, we were so excited that these models could predict if a transaction was fraudulent. And I remember, if you go back to November, December of 2019, someone would swipe their card or use their card online, and we were so accurate on figuring out if it was a fraudulent transaction. We'd message the customer, is this fraud? They would say yes or no, and our rates of yes were like through the roof. Like we were stopping fraud, but also kind of balancing false negatives and false positives, because we were stopping fraud, but not having too many false positives where the customer is getting frustrated. So that was wonderful. Then what started happening in February and March of 2020 is the fraud detection model, both for credit card and for debit card, started breaking down. We were missing a lot of fraud. Fraud rates were going up, starting in, they really bottomed in January of 2020 in fraud losses for a lot of banks. In February, started moving up. March, April, fraud losses started going up at banks. Also, the percentage of false positives was starting to shoot through the roof, right? You had November, December of 2019, you had January of 2020, and then you had February, and then boom, you had March, through the roof on false positives. So we're taking huge fraud losses out of nowhere, and then we're getting huge customer dissatisfaction that they're constantly happening. So what happened? We looked back at our fraud model, which wasn't the easiest to look at, had like 900 features. And we did an attribution analysis, and we figured out the feature that was the most predictive of fraud, right, was card present to not card present ratio. So what does that mean? So you take a customer and they say when they go to use their card, either they swipe their card or insert the chip, their card's present, or they do it online. If that transaction is really different than their historical pattern, it's more likely to be fraud. So if your last 100 transactions, for example, your card was present, all of a sudden your card's not present, we assumed it was fraud. Well, what happened in February of 2020 and March of 2020, there was a global pandemic. There were stay-at-home orders, there was quarantining, there were safer-at-home orders. So people, like my mother, for example, who had never before pandemic bought anything online, all of a sudden was buying shoes online and clothing online and, a laptop online, like all sorts of things. She constantly got messages, this is fraud. It was on hold. She said it wasn't fraud. It still got stuck. She had to talk to a human. She had to wait. And so it was stalled. And my mom called me. She says, you're the head of model risk. I'm using your card. Why can't you get through? And I explained the pandemic and machine learning models to my mom, and that didn't go so well. And she was like, fix it. So I said, all right, I'm a good son. So we talked to the modeling teams, and not just to fix it for my mother, but to fix it for all customers, and that the model had overfit. it had overfit on this really predictive variable in a pre-COVID world, which was if you are always doing card present, you switch to card not present, meaning you're buying online, it's fraud. That didn't work anymore. Our world changed. And that day when my mom called me and she's like, this isn't working, and I started explaining machine learning to my mother, she's like, it's not working. Nothing I can do is bought. My card's frozen. I was like, you know what? We might need to tap our brakes a little bit here. So I give credit to my 79-year-old mom. But yeah, that's kind of my experience with AI. That was the most formidable in my life.
Oh, you got messed with your mom.
Uh, can I make a comment here? Sure. Here.
Yes, please. Yes, please.
Yeah. So the kind of background you have given, Jacob, is really fantastic. But I can tell you one thing: um, this particular case study that you have given is there for everybody, and that's why the hyper personalization has many of the people, even the educated people, have started looking at how do I do the hyper personalization. Will my account operate on an e-commerce domain? Will my account operate on international transaction? Can I buy certain things? So all along we never got into any hyper personalization, so to say, right? So this situation has really brought up and started thinking like, how do I personalize? How do I make sure that I buy things online? How do I control the money that I'm actually spending? I think that's where the whole shift in the way customer accepted this digital technology has come up, Jacob.
Yeah, I agree.
Thanks, Shiva. Thanks, Shiva. Really. It's very funny way also you presented, Jacob. Yeah, please, Ben or Harish, did you face anything like this situation in your experience? Especially Ben, yours is the major area. The one which Jacob is talking is payment area.
That's it. It's all of our people that are making everything crazy for the banks. But I think for us, a lot of it's also on the auto approval side. So a big part of where AI is being utilized is on even just approval of new merchant accounts. And so very similar to what Jacob mentioned. On the payment side of it, we try to obviously speed up the approval process. And, look, if it's a basic restaurant, that's 90% face-to-face and 10%, a little bit of phone orders, no big deal. But then really right in line with what Jacob said, once COVID hit, those restaurants that were all face-to-face and everyone was walking through the doors, suddenly we're all, I need online ordering, I need this. So then, boom, holds are coming on accounts because this restaurant suddenly is this e-commerce business. What do you mean? It's not, it's not e-commerce, and it just became kind of a whole kind of cycle that we had to kind of work through. So I think one of the key things that ended up being implemented really across most of the industry, and in a lot of ways has stayed as a standard, is daily discount. So where as a processor, the fees are being pulled daily instead of us waiting till the end of the month and then getting all our fees. Then it obviously doesn't protect against the fraud and chargebacks and all of it, but at minimum it protects loss on if the business went out or whatever. So there's that's I think just one example that is where we've seen it is on those auto approvals and those basic retail businesses that once were very simple and easy to approve aren't as much the case now, because now it's they're doing drop shipping and they're selling online and all sorts of other stuff that opens them up to a ton of fraud and what I would call a friendly chargeback. It's a real customer, but it's someone that they didn't get their order as quick as they expected, so they charged it back. It came in the next day. They still kept the product, but then they had already charged it back. And are they going to go and call the bank and say, actually, I should pay for that? Unfortunately, they don't do that, and then we're dealing with that. So I think that's one place where we've dealt with it and how we approached it.
And I want to add on to Ben there. I think with our models that are designed to your point, assess if there's been a takeover or some sort of problem with the merchant, right? That the merchant there's a vulnerability. Is that before the pandemic, again, if there was a restaurant that was 90% of its credit card transactions were card present, and all of a sudden you have all this non-card present transaction, is it the pandemic and no one's coming to the restaurant anymore? Or is it people have stolen cards, or someone has a nefarious actor is doing something inappropriate, and it became a lot harder. And this is where we had this, I think, in some places before the pandemic in January and early February of 2020, there was a lot of hubris in these financial crime models, in these fraud models, in these customer authentication models, in these AML models, and they broke down. And I mean, I think that real world change showed us that models, by definition, predict the future based on the past. But when the future changes, this isn't going to, the present changes.
It won't miss. Yeah. Improvement
It's
is
not going to
needed.
work
So,
anymore.
yeah, I wanted to bring one point to the audience.
Even at the
I want to bring one point to the audience. If you are going to apply for a loan process or anything, first, if it is declined, okay, it's denied by bank, talk to them, ask them, did it processed by AI or human? Okay, I'm bringing the suggestion to you all so that we'll come to know the data can be pulled back and it can process again as per input from Jacob. Okay. Okay. I'm going to ask them, hey, who processed this loan, denied this? Oh, yes. Yeah, no, I want to go through manually. Yes. Sounds great. And
even
the
one of the
yeah,
right,
please go on.
sorry to interrupt. One of the things I want to bring it to this forum is now I could sense many of the fake wallets are being handled, and wherein yes is going to be very difficult to track those because most of them are API driven. Now there should be an alternative solution that we need to look at to see how we can avoid these fake wallets. So when we talk about like Paytm and other things in India, also we could sense many of the fake ballots are being done. I'm not sure about other countries. So that's an area of interest we can have to see how do we curb those fake ballots because especially now we have gone everything online. I think there's something that we may have to look at how do we handle this.
Thanks, Sean.
Mainly,
Thanks for the input. I have only 3 minutes. I have to go two questions from the audience. First question, Mark. He asked for automation and machine learning can be considered to fall under the umbrella of AI. Do other AI-based tech like natural language processing and deep learning have their place in the banking and AI/ML context? Who would like to take it?
Yeah, I mean, like we see NLP, natural language processing, used in a number of different ways, right? So a clear example of that is like chat, for instance, like chatbots, chat transcripts, recording some of this information, capturing as text. That's one example of where AI is used, like in when it's around collaboration and communication. So there are use cases for that as well.
Okay, sounds great. Sounds great. Hope Mark it got clarified. This anyone else, Ben or Jacob, who would like to take, or should I move to next question?
Next question's fine for me.
Okay, I have a questions related to his name is Himanshu Chaudhary. I have a questions related with respect to the bank customer rights as to how much we need to hinder the privacy policies to make AI learning possible. To develop a learning pattern, I think we have to read the statement of the customer, which could be private transaction, and some if the customer doesn't wish to share.
So for us, the privacy is crucial. We're not going to use any statements or any transactions or any scripts unless you're already providing that to the customer. So let's use our our robotic agent when you call in. In the beginning, we state, and this is where it's changing, where we say these recordings might be used for quality assurance purposes. So for that's for refitting and retuning the model. And so the question is refitting the model based on statements the customer says. Do we need to clarify that and say, anything you say is can be reused for quality assurance? We think quality assurance counts as is broad enough to include re-estimation of models. So for us, we're giving that. But I do think as long as we're giving as long as we're giving customers heads up that things are being recorded or transactions are. But it is a balance, right? If somebody writes on Facebook, I'm going to default on my mortgage next month, and like somebody happens to see that, and you're like, can you use that? I mean, they're writing, I'm going to default on my mortgage. So there's a question of what's private, what do people put in the public domain, what do they not put in the public domain. If someone texts somebody, I don't think we should hack into their accounts and they say, Mom, I'm missing my mortgage. And we're like, haha, we caught him. Like, no, that's not cool. So I do think on privacy, we just have to be thoughtful that privacy is upmost to the customer. And if we're going to use data, they're aware of it. If we're going to sell their data to third parties, we have to really think carefully on that. We have to get their approval. There's a variety of laws, obviously, in this space. And then really be clear what's in the public domain and what's not in the public domain. Somebody not paying their landlord, is that public or is that private? You know?
I would love to say this is an area that's accretive to the business.
Sorry, someone is talking, I think. Sounds great. Thank you so much, Jacob.
Hey, Jacob, just a quick comment, right? I was saying, right, the case, right, example you were referring to, that's very refreshing, right? And so in the privacy, I was saying the statement versus fact, right? That could be different, right? Even under the same, right, kind of concept of privacy, right? And for the fact, probably there will be ways to evaluate, right? To be including those, right? But for the statement that you were saying, hey, I'm going to miss my, mortgage, right? And even if, right, there's no private issue, that type of thing, that just statement, right, it'll be hard, right? Social media tend to more, I would say, proliferate, right, in terms of statement than fact. How to differentiate those two? I would think that could be, right, something, right? And yeah.
But so here we found that if someone uses an ATM at a casino, that's like negative 10 FICO points. Bam. Like people that use ATMs in casinos default more than everybody else. Like no matter how you slice the data, that's the reality. So then the question is that private? Oh my, how do you know I'm using my ATM at the casino? Well, it's our company's ATM. How come you use that for the credit decisioning? Well, we use your deposit transactions for credit decisioning. Like it's the same company. That's what we do. It's private where I use the ATM. No, it's not. Like we know you stop using ATMs, stop using the casino ATM. We know that's correlate with default. Like what the hell are you doing? The question that there could really be this conversation that where you use your ATM card, is it private? For us, that is such great data. It's hard to think that's private. They're using our ATM, and we know that's like just telling us you're going to default on your mortgage in 5 years.
Team, we have a hard stop now because the other speakers are waiting. And definitely nice talking with all of you. Jacob, you stole the show. Harish and Ben, wonderful input as well.
Thank you. Appreciate you taking the lead on it.
Thank you all.
No, thank you guys. I think it was a lovely discussion which kept on happening. So thank you all. Thank you for the
Thank you.
Thank you, Chitray, for moderating it very well. Jacob, everyone. Yeah. So next, we'll move on to our next presenter. We are exactly on time. So just to let all of you know, we have 4 great speakers who are up for the next few talks. One is Kim, then there's Andrew, then it's Peter, and then it's Pranav. So we'll start with Kim's talk now. So Kim is of Great Innovation and Power Financing. His topic is developing and implementing AI ML in operational functions. Over to you, Kim.
Thank you, Nathan. And what a tough
Kim,
act.
you are looking at the background.
Unfortunately, my light just went off here. So it's I think the cable came unplugged a bit. So I am backlit. I apologize. I might look like a sinister, evil villain. I assure you I am not.
No issues.
So I apologize for that. But I'm going to share my screen to get the presentation going. And let's present from the beginning. All right, and since I'm doing the full screen, I'm actually unable to read the questions as they come in, so I'm trusting Nitin or somebody can interject on.
I'll let you know, Kim, in case question comes. You can continue. Thank you.
All right, so just a quick introduction for those who don't know who I am. I'm Kin Chung. I am the VP of Credit Innovation, also known as Head of Credit for Empower Financing. We are an educational financing lender and primarily focused on international graduate students. But so I've got a lot of interest in underwriting because I actually have responsibility for the underwriting area in addition to the credit policy also. So I'm going to begin actually by asking, why would you want to automate underwriting and using this as a model for automating like financial operations in general. So, I tried to be clever here, came up with 4 C's or what I'm calling the other 4 C's. So first and foremost, one of the most common reasons for automating underwriting is cost reduction. Traditional underwriting is very manual, and there's a very high variable cost component on that. So, and the costs tend to scale with volume, and this makes it difficult for companies, especially startups, to realize economies of scale. Startups think once they get big enough, my costs will amortize down a lot, and we'll be able to get profitable and so on. And then they find that, let's say they've got a big underwriting component like a mortgage startup. They'll find that these costs actually scale quite rapidly with the volume also. So automation can reduce this variable component, and therefore you can realize economies of scale more quickly. Another reason to automate underwriting is the customer experience. We've heard in the previous panel discussion, manual underwriting takes time. Customers want instant gratification these days, right? So, automation lets you do 24/7 processing. So, with very busy customers, I know in my case, I would tend to submit documents on the weekend or on evenings. With manual underwriting, unless you have someone overseas in a different time zone, they won't get a response till the next day or maybe over the weekend, next business day. So, with some automation, they can get better feedback directly. Compliance, right? So, with manual underwriting, there's humans involved, and human judgment, data entry, that's prone to errors. So if you automate that, you can reduce a lot of those types of errors, and also your outcomes are reproducible, which is great from a compliance perspective. Errors could occur, but those tend to be systematic errors, which can be corrected more systematically. And then finally, capacity planning. From my experience, underwriters take time to train, up to 3 months, and then before that, they might have to go through different rotations and the background knowledge just to become an underwriter. So if it takes that long to train somebody, it becomes difficult to react quickly when you have rapidly changing demand. So, for example, there's a refi boom from lower interest rates. That can stress the underwriting capacity of a lender, right? Because you have to hire quickly, bring in more staff. And then post-boom, when the volume drops, do you want to let these staff go or not? Because it takes time to retrain them if volume comes back. So it makes it harder to manage capacity and manage your expenses there also. So if anyone wants to share other reasons for automating underwriting, I'm happy to just bring that up here. But otherwise, let's continue. Nitin, any comments there? All right. So now that we've talked about why automate underwriting, let's talk about why is it hard to automate underwriting. So it's because there's more than meets the eye, right? More to it than what meets the eye here. So it depends how we want to apply AI and ML to automate this, right? So what I've started here with is a very simplistic diagram. It represents a typical job description of an underwriter. So let me give you a few of the bullets there. I'm going to read this off. Reviewing and verifying loan applications, supporting documents. So that's on the left side. I've got some icons for information, application information, documents. They analyze the loan risk, requesting additional information if necessary. So they do the 4 C's in the middle. And then at the end, they approve or reject applications, right? And all of this ensuring that there's compliance with policies, guidelines, regulations, etc. Right. So if we treat this middle process as a black box, we need a lot of data to train AI ML models to replicate this approved decline decision accurately. AI ML problems require big data, and in this case, this is a big problem. It requires even bigger data, and I think the data needs here actually exceed what is feasible with the technologies today. In the previous panel, I think Harris mentioned that, that we need to break down this process into smaller components that are more suitable for the different AI ML techniques. So let's start to break this down a bit. In reality, the output of the underwriting process, right, isn't just a loan decision, yes or no. You actually have a list of metrics that are calculated formulaically, and then from those metrics, we can actually apply certain rules to get to a decision. So if you code those rules, what we're really trying to generate is the metrics, and then derive the approved decline decision from that. So this problem becomes significantly easier now because we don't have to try to infer what these metrics are in our AI ML training. On the other side, there's documents also, and most underwriting shops already implement some sort of doc prep process. However, we can, this is a fairly mature area for automation. There are IDP or intelligent document processing platforms out there that you can license and that apply AI ML techniques and perform this specific task. So what they'll do is they'll take the documents as they're submitted, review them, classify them, extract the key data elements that you want from those documents. So once you capture those data elements, you can feed it into your credit evaluation or the box in the middle, and then generate the metrics and then make a credit decision. So the problem is, again, getting broken down, but you still have to deploy the doc prep, the tools there. Okay, so let's go on to the next step. How do you handle changes in underwriting guidelines? So if parts of the guidelines are incorporated into your AI ML algorithms, then you have to retrain with new examples whenever the underwriting guidelines change. So let's say you're underwriting Fannie Freddie mortgages. If they update some requirements and those requirements are somehow coded into your AI ML logic or the training part of it, then you've got to find new examples to train them to learn what the new guidelines are. So if you want to be able to respond quickly, it is necessary to have an interface that lets you encode and update these rules systematically, and therefore avoid the training of that. Okay. Next, we come to one extra part of the process that's not documented, that a lot of people don't often recognize, and that's the interaction with the customer or the front office. So a good underwriter can often save a loan application that would otherwise be declined. So I think we heard about the fast decline. Jacob mentioned this as decline somebody quicker, right? But when you AI ML, you get quick decisions approved, but you also get the quick declines. But a good underwriter, right? They might notice an applicant is lacking funds, but there were other accounts listed in one of the bank statements. So you can ask to check, if they have other funds that they can use as reserves. And then they submit that document. Okay, great. Now you're approved. So underwriters can help improve the pull-through or conversion rates of applications, and then this generates more revenues for the company. So if you don't include this feedback loop in whatever process you're trying to automate, or at least be able to keep that separate and have humans be involved there, you would be potentially reducing the revenues of the company. All right. And then finally, these 4 C's in the middle, we can break them out into individual components that'll be easier to manage each one separately because they involve different sets of inputs. They involve different outcome metrics. So we can actually break this problem down into lots of small components. And now that we've got all these components, we can look and pick and choose which ones are the most appropriate to automate today. What technologies do we have to be able to address some problems quickly, and where do we need new technology in the future? And you might want to delay that. All right, so let me move on to what's needed. Now that we have looked a bit about how to design and how to break up the process so that we can it's more amenable to AI and ML, what are the ingredients for success with doing this? And I'll talk on the next few pages about these 3 items at the top there. But before I get to those 3 items, I want to highlight the importance of the last 2 considerations at the bottom there: designing for flexibility and avoiding vendor lock-in. The AI ML technologies are advancing so rapidly today. I mean, even if you want to build something yourself, 2 years from now, maybe there's a vendor that can do it better and cheaper. So you don't want to be locked into a vendor. You want to have the flexibility to plug and play with a new vendor if these technologies come along very quickly. I mean, technology, as I said, is improving so quickly. What was cutting edge maybe 5-10 years ago? High school students are actually doing that in their school projects these days. And so, you can get, in many cases, open source libraries to do a lot of AI and ML models that were proprietary just 10 years ago, or even 5 years ago. All right, so the ingredients here that are important is data capture. Without data, it's very difficult to implement AI and ML. Knowing which places to automate. What is your sequence for automation? How do you automate different things, and what is your goals for your automation? And then finally, how do you transition from your current process to each incremental automation that you implement? So let's talk about data capture. Underwriting is a process, not a snapshot. So we really should be capturing the customer's journey, the entire timeline. I'll give you an example, right? Like going back to the underwriter who can save a decline and make that into an approval. What happens is you've got some initial set of documents submitted. If you look at that initial set of documents, they would be declined. Magically, if you didn't capture the data, what happens next is somewhere along the way, customer submits new documents. Based on the final documents, they're approved. But if you didn't capture the entire journey, when the documents were submitted, what led to these documents being submitted, and then how you got to the endpoint, you would not be able to capture that somebody intervened to change that the outcome of the application, or the initial outcome of the application was changed because somebody noticed something and interacted there. So it's imperative to capture this journey so that we can see every step that's happening there. A lot of underwriting systems, they only capture the final numbers, the final details, and the inputs, and then these steps maybe they capture it as text notes that someone writes a very long paragraph or so to explain what they did. That's not structured data. Even to analyze that, you might have to use NLP and sort of lose a bit of the richness of your data when you do that, or the accuracy of the data. So if you can replace text notes with structured data, that's going to help. I mentioned the capturing of internal communications between front and back office. So the underwriter who saves that loan, quite often they might have made a phone call, and that discussion has not even been captured in your data. And then finally, if you want to know, how much time you're saving, etc., you probably need to record the time needed for each of the steps in that the granular diagram I ended up with a couple of pages ago, like over here. You probably want to know how each of these components, how much time is taking overall. So you can capture the time spent in each of these components. It helps you target what you want to automate. All right, so targeting, how do we all automate? Let's solve the correct problem. First of all, what is your goal? Do we want to reduce time? Do we want to reduce costs? Are we trying to focus on error reduction because we had a lot of compliance issues? Second, another consideration is automation should impact only the targeted segment. Sometimes I've seen some efforts to automate something. They fully automated one area, but they made something else worse. And then finally, how much automation do you need? We talked about, I think, in the previous panel, Harris mentioned, agent assist. I think I call it, something more like an analogy to driver assist. Ben also mentioned that you would use machine recommendations, but you still want a human to review that. So, do you want to automate it fully, or do you want to go with a route where, there's a certain confidence, you automate partially, or do you just have everything reviewed by a human with a recommendation? So I'll give you an example of why we want to make sure that we don't impact non-targeted segments, right? So if you have two types of tasks, type A, which is 70% of the number of tasks you have to do, but they take 10 minutes on average. And then type B, which is 30% of the number of tasks, they take 30 minutes on average. If you automate A and eliminate that time completely, but somehow in the process you introduce some inefficiencies for B, and it doubles the time required for B, you're actually going to take longer overall. Right? And then if you actually look at that, the initial instinct for a lot of people would be to automate the 70% because you do more of those. But if you look at the time taken, you actually spend more time on B than on A, even though there are a few of them. So we actually would be better off automating B rather than automating A. One good, I think one good principle to adopt here is actually talk to the users, talk to the underwriters. Which one would they prefer? Would you prefer them to automate? Would you prefer, would they prefer that A is automated or B is automated? Which one's more annoying for them to do? I think the human element is very important there also. And then finally, the transition planning. Right? Is your organization ready for this automation? Like if you've designed these ML processes in the back, then you talk about how do you introduce that. Sometimes you have to rip. Do you just change en masse from one process to another? How do you deal with in-flight loan applications? If you're having a large volume in your pipeline right now, how do you transfer those over to a new process necessarily? So, to be able to facilitate that, I think it's important to set up AI and ML processes to be configurable. So you can turn it on, you can turn it off as you're making those transitions. You might want to run them in parallel and migrate individuals gradually, so they have to plug in fairly seamlessly. It had been mentioned also in our previous panel. Jacob mentioned this. Models could break down. Like for example, at the beginning of the pandemic, when we went remote mostly, the AI models may suddenly start behaving in unintended ways or inappropriate ways. So, you have to be able to shut that down quickly. Otherwise, it could impact a lot of your business, or you have to be able to mitigate that quickly. And we mentioned this on the previous page. The transition could include, driver assist or agent assist instead of full replacement as a step to full automation. And then as you get more confident, as you get feedback from the users, the underwriters, this is working. I'm always agreeing with the recommendation up to a certain confidence level, or above a certain confidence level. And then you can turn that on to be full automation, maybe hold out a small sample for QC purposes and just continue to review those. Clearly define and preserve the handoffs. So again, back to that diagram I had, these are components, and if you can define clear interfaces between them, it's kind of like APIs, then you can plug in new modules in each of these areas without affecting anyone outside that box, or each of the smaller boxes. So this is part of the, again, do not impact areas that you haven't targeted. By being able to define and preserve these handoffs, you're less likely to impact those areas. And so now you can test and iterate, training for these new processes, right? You can have 1 or 2 people roll out on that process on a limited basis, see that it's working, iterate on that, and then try to run existing processes in parallel with the new processes until you're ready to migrate in full to the new process. So I think, yep, that's it. I've wanted to thank you for listening to me and letting me share some of the learnings and observations I've had over time involved in trying to find ways to improve underwriting using the modern AI ML techniques. I've put a LinkedIn profile there if you want to be able to contact me. Opening the floor to questions right now.
Yeah, so there's one question for you, Ken. Aside from traditional underwriting, where is automation beneficial from an operational perspective in a financial enterprise or bank? Is 100% automation with no human intervention possible? An autonomous or self-driving bank, if you will.
That's great question. So I think other than underwriting, right, you can actually use automation in lots of places. For again, I apologize for being backlit here. I think automation can help even on the front end. It can help on customers service, or even on the account servicing or loan servicing. Just because we can answer a lot of the easy questions quickly. Again, being able to provide the 24/7 support instead of having to hire people to cover all the different hours during the day and also the weekends. So where we can understand customers' behaviors, even like when to contact somebody. If you, for example, you can predict the best time to call somebody, and then we're not trying to call them at different times or trying to set up a meeting schedule. If you are able to predict when somebody's likely to be to respond to your outreach, we could call back to them on those areas. So there's a lot of places where AI and ML are good for. Again, we've talked about document submission. I think maybe a good way to think about this is to look at the type of problems that AI and ML are good at solving. The different categories like pattern recognition, so whether it's visual patterns or patterns in transactions, you've got that type of recommendations. There is, like next steps recommendations, kind of like what Netflix does with, recommended for you. You can actually recommend financial products to them or actions they might want to take depending on what their goals are as a customer. So those are places where I think AI and ML can plug in to help build the customer, improve the customer experience there. Is 100% automation with no intervention possible? I would guess eventually when the technology is there, it's probably possible. You will always need some sort of person monitoring it to say that, am I getting the results I want? So, if we could replace it with a bot that can monitor that, I think that is possible. But you have to define what your metrics are. So at the end of the day, it's about, what problem are you trying to solve? So I get back to that. What is your goal? What's your objective? What problem do you want to solve? Monitoring that, like, as I said, Are you trying to reduce costs? Are you trying to reduce the reaction time to the customer? That's what you'd be monitoring, and then trying to fine-tune your algorithms to be solving that.
Sure, Ken. Thank you, Ken. Thank you for your lovely feedback for the question and a presentation as well. Hope to see you soon. Thank you.
Yeah. Thanks, everyone.
Thank you. So we'll quickly move on to our next presenter. Andrew is EVP and CTO of Old Second National Bank. And his topic is the use of machine learning and artificial intelligence by financial institutions to manage BSA and AML risks. So over to you, Andrew. Yeah, thank you.
So, as Nitin mentioned, today I'm discussing managing AML and BSA through machine language and artificial intelligence. And this area is incredibly complicated, and it's evolving. And if not done properly, can put an organization at risk. And when we talk about risks for a financial institution, it can impact business plans, it can impact growth strategies, whether you're talking about organically with new lines of business or mergers and acquisitions. If not done, it can present barriers as well as reputational risk. So that's why it's important, and that's why it has to be looked at. I would love to say that this is directly accretive to an organization and we're going to demonstrate true, pure return on investment. But in my opinion, it's not. It's preventative and it's incredibly necessary. And if not done effectively, can have extremely negative consequences. Whether you're regulated at the federal level with the FDIC, the OCC, or your primary regulator is a state, or your credit union, this is an area that remains one of the top priorities for oversight. And it's for a financial institution, this is not getting easier. It's just continuing to get more complicated. BSA has been around since the 70s. And in that time, there has been over 30 meaningful changes that have not made it easier, but has made it more complicated and required institutions to do more things. And it's not going to change. And if you just look, I just have a sample of some of the new requirements and rules that were put in just through 2003. And if you think in terms of just this week, with the administration introducing new sanctions, that is going to have a direct impact on the organization. So not going away, and it's something that for an institution that you have to continue to get more efficient and more effective and far more cheaper at processing those transactions. So when you think in terms of an effective BSA program, what we're talking about 5 components. And why I bring this up as technologists, we need to understand the subject matter or the business unit that we're supporting. We don't do technology for the sake of it. We don't buy tools and look for problems to implement them. For a tool to be effective, it has to align with the objectives to solve a problem. So whether you're talking about internal controls or oversight or a compliance officer, all of these things have an aspect where if technology is effectively applied, can make lives easier, transactions process factors, or the cost of ownership reduced. Whether we're talking about the types of transactions, truly knowing what are the transactions, how are they being presented to the institution? Whether you're talking about validation and oversight, testing that model. A lot of these things may have different terms or different expectations, but it's still from a technology perspective. When you introduce a tool or a software, how are you validating? How are you improving it? So from the notion of, is it being tested? Do you have third-party oversight? Do you have a model that lacks transparency or visibility? I've been in an audit meeting where a management individual used the term black box, which most of us around this virtual table, probably have cringed when you heard that term. If there's no visibility, there's no insight, how do you know it's functioning effectively and based upon the objectives of the program? You can't have that. Knowing your customer. If your customers are going to initiate the transactions, if you don't understand whom they are, what their behavior is, how do you build rules to effectively assess, analyze, and decision those transactions? Yeah. What we're talking about here is risk, managing risk. And as technologists, those may not necessarily be natural terms that we always think, but we're there to support the business, to address requirements, to solve problems, and we have to adopt and embrace what they're trying to accomplish, as well as to be able to align with needs. Moving along, for us to run an effective program, there are really generally three audiences that we have to meet. Whether it's the regulatory audience, in other words, are you following the rules? Do you have an effective program? And can you demonstrate that it's effective? Management's expectations are you balancing risk with being cost effective? We're not spending more resources than we really need to fall within the risk appetite or threshold. And then finally, that other audience, which is the most important, is, are we processing our client or customer transactions? Are we doing it effectively? Are we protecting them? And are we decisioning those transactions, processing them effectively, and not having false positives or denying a transaction based upon poor assumptions? All of these things that we're talking about is managing data, lots and lots of data. And so where do we go with this? What does this actually mean? As I've said, it's managing risk, managing it, making good, effective, appropriate risk decisions. When you think about the level and the volume of data, it just has continued to grow. And what you're seeing here is not necessarily raw, pure transactions. This is the data that has to be effectively reported to Treasury for financial crimes. And on a basis each year, that number of transactions that has to be effectively and appropriately analyzed and reported just continues to grow. And the types of data, when you think in terms of when this started to where we are now, there are 97 individual categories of data that potentially could require a reporting requirement. The rules are not getting easier. They're continuing to grow, and to be able to effectively and accurately analyze a transaction can't be done by human individuals. it does require technology and automated processing. So when you think about this, well, how do you do it? And I'm sure a number of you have seen this model and the evolution and how it's adapted. When I was in college, there were only 3 levels: data, information, and knowledge. Now, when I've seen it, you add that 4th generation or that 4th level in kind of beyond the predictive and a longer term of where are you going with it. You can't make decisions based upon pure raw data. And information, certainly that'll get you somewhere, but it's not going to be effective or accurate. For us as an institution and as a bank, we're approximately $6.5 billion in assets, which, when you look at it from a grand scale, not small, but certainly not large. We cannot effectively build our own tool, maintain our own tool, and ensure that it's sized to meet the needs of the transactions. It's just not cost effective. Therefore, for us, identifying a solution, and that solution can either be through a vendor with commercial off-the-shelf technology software, or with a partner. And for us, we view it as it has to be with an effective partner that not only understands what our requirements, and how do you pair up the software with the needs and with the actual behavior of our customers, but to also objectively and in a somewhat confidential and sanitized manner, when you ask the question, what are other institutions doing? How are they handling X or Y risk? It's having that partner. It's investing the time for us as an institution to know that the tool has backing and support, and the partner does understand the implications. BSA and AML is not something that you can simply just plug and play. It's not simply a topic. We can just say, well, it's analyzing tools, or it's an analytical tool. Well, no, it's an evolution in truly knowing how you process and how you factor in not only customer behavior, but also the externalities of regulatory oversight, as well as risks and threats from fraud, from malicious, from parties that may or may not be permissible to complete transactions. So all of these things, and truly having a partner that can be able to understand our requirements and support those. And when you think in terms of how you move along the evolution, there is a level of maturity. And most small institutions, well, every institution started off with those basic rules around you're capturing the data, you're capturing or you're building a baseline of your customer activity, you're running the data through, and then hopefully you're making the right decisions, or you're making more right decisions than missing information, and then slowly going through. And with our data processor, it's basically the timing and when is it effective to go to that next generation. And one of the points that was brought up in the last session, are you going to get to that 5th level where there is no human intervention? That certainly is the nirvana end state, but the reality is it will require, and it will continue to need a level of human input to ensure that the model continues to adopt and incorporate rule sets, data types that are evolving based upon our institution. One of the things that I wanted to kind of just from a level set, and when I was putting this presentation together, just looking at AI and machine language, machine learning are terms that are constantly being interchanged. But from an AI perspective, it's really, can you make intelligent machines? And with that, from a machine learning, are you able to develop a program that can imitate intelligent human behavior? So in other words, taking large amount of data and making effective decisions. And I'll use the theme again: faster, cheaper, and accurate. And accurate in reality is aligning with your objectives. It's building a set of rules and how close can you make decisions that align with those rules. From our perspective, when we've implemented these things, there's three different types of analysis. And again, working with Jack Henry, you start to understand where are we going, where we came from, and what are we trying to accomplish. And those early approaches to BSA analysis, you either had a big access database and you loaded in and you created a certain set of queries that extracted out types of data, and then the notion was, well, you look at a report and, well, we either saw a few transactions that fell into the category, we filed the paperwork, and we moved on, rinse and repeat. Well, as your customer base grows and as the evolution of transactions from simply in branch or traditional paper types transactions moved, we've shocked in the last 24 months. We've shocked the system and shifted the volume of transactions, and the individual components for analysis have continued to get much more complicated to analyze. Well, it requires a different set of rules. And that's where you get more and move towards more of a predictive and then the prescriptive. How do you, in the future, where are you going? How do you adapt it? Again, how do you get more? How do you process those transactions faster, cheaper, and more accurate? For us and most of the institutions that I've been associated with, putting models, AI, machine language still comes back to these lines. It involves people. It involves documenting your processes before you can get to the technology. If the individuals don't understand the subject matter, if you don't have consistent processes in place, just putting tools in is not going to necessarily solve your problems. It is just, you're in one risk, you end up having parallel paths where there's a lack of trust. And you may be running a model, but you have a group of individuals that want to just verify or reviewing the data just to make sure. Because while we don't have that visibility into the model, if you don't have clear objectives of what you're wanting to accomplish or what the model, the tool is trying to achieve, you're going to flounder. And the other aspect is data integrity, data accuracy. The old term, garbage in, garbage out. If you don't have a level of confidence in your data, whether it's the baseline customer information and knowing whom your customers are, and what types of activity or transactional or line of business or marketplace, if you don't have that information, you're not going to, if you don't have that data, you're not going to gain some information or be able to decision and make appropriate post activities around it. So in conclusion, when we think in terms of putting in a model and or leveraging machine language, what's the benefit to it? Are you going to reduce your resources? Can you process a greater amount of transactions? What is the risk to the organization by not doing it? The regulators are no longer just simply looking for programs where they're checking the boxes off. Or do you say you've got this model and they're comfortable with it? There is a level of expectation that you can demonstrate how your model works, how it adapts, and what's the accuracy of that model. Is your data defendable and have a level of accuracy and certainty to it? We all know that data is never perfect, but do you understand what level? How are you testing your data? That level of accuracy will then allow you to drive more and more complex rules, which will provide you, or which should reduce your false positives. What are the questions that you're trying to answer, or what are you trying to accomplish? Is your customer behavior adapting, shifting, changing? Are you simply trying to adjust or streamline? Are you looking to mine this data for other purposes? I've always viewed regulations in the terms of they're unnecessary. Financial institutions, for better or worse, if you don't accept the fact that we are highly regulated and can't find a happy medium from just blindly following rules to basically taking a rule, and can it not only can there be compliance, but also can it be value added? You're collecting all this data. Are there other business units that could leverage it and be able to add to the business? Do you have control over the system? It cannot be a black box. There can't be. There has to be transparency into it. It has to be validated. It has to be adaptable. The rules are constantly changing. The behavior of our customers or clients is constantly changing. The types of transactions are constantly changing. The regulatory environment is not clear. If you're a federally regulated institution, what are the implications of medical marijuana? Are those transactions permissible? If you have a client base if you have customers that do online gaming and gambling, are those transactions permissible? How do you analyze those transactions and process them in a predictable manner so you don't create unnecessary false positives, which then trigger customer frustration, increased calls to your support centers, and just disruptions. Once again, visibility. Does your company have a culture to embrace automation? That's one of the early things that you need to make sure. As you add and increase the level of automation and use of modeling, is everyone in sync? Or is there going to be resistance, a lack of faith? And is it going to be a hands-off? If there's problems, if the model doesn't work, is there communication to solve? Or is it going to be a hands-off situation? It's going to be a hands-off where, well, that's a technology problem. That's not a business unit problem. It's making sure that individuals are bought into the process. And finally, how are you growing the model? How are you validating it? Are you waiting for a third party to test it, or are you taking the time to ensure that it's measured? I heard the notion with one of the earlier talks, is it a Tesla where it's just a one and done? No, it is never finished. But if you consider the volume and the complexity of the data, this is a necessary requirement as opposed to a nice to have. So with that, I'd like to turn it back over to you.
Yeah. Thank you for the lovely presentation and showing a lot of insights into what we can do. There's one question for you. How is your firm developing guardrails to mitigate AI risk?
I would say that we're probably in kind of that between the second and third kind of level of decision making. So the notion of still having a more involvement than I probably would like with humans in validating the rule sets. What I would also say that we are in the midst of a acquisition, so we are not an acquisition, but a system conversion. So having, I would kind of call it having the time to lift the hood up, and with a new customer base that we're going to be bringing in, it is forcing us to retest those baseline or legacy rules and go, okay, well, what is the new customer base? What is it going to do? How do you shock the system? So it still requires a fair amount of we're not near that level of nirvana yet. So does that answer the question?
Yeah, Andrew. Thank you for your lovely thought and sharing all the thought process which you have to manage BSA and AML risks. Thank you, Andrew.
Thank you.
Love to see you again. Yeah. So we'll quickly move on to our next presenter, guys. We have Andrew. Andrew, are you there? Sorry, Peter.
Yes, I'm here.
Yeah, great. Thank you, Peter. So Peter is co-founder and CEO of Castellan.ai. His topic is automating compliance. Over to you, Peter.
Thank you, Nathan. Can you hear and see me all right?
Yeah, I can hear you.
Okay.
And see you. Yeah.
All right, wonderful. Thank you. I want to thank you, Nathan, and also thank AI CoreSpot. And I do just want to say, if there are any questions, please feel free to ask them right away. Don't wait until I'm done. So I wanted to talk about the role of artificial intelligence specifically for screening, and some of the other speakers have talked about this already, but I like to use in comparison of screening as apple pie. So, what apples are you getting and why? And this is important because if you procure the wrong things, the previous speaker said garbage in, garbage out. So the goal is that watch list data should help you comply with regulations, reduce risk, and minimally increase costs. I do believe, of course, that compliance is important, but compliance is a cost center. And it's very difficult to justify compliance expenditures. So when you are doing this, kind of the less expensive something for compliance is and the more efficiencies it brings, the better. In practice, though, watch list data creates tripping hazards. It increases risk actually due to poor implementation and usually massively increases costs. And so one of the worst things that we see happen is when organizations buy expensive technology before they actually understand their risk and before they know what kind of watch list they should do. So it's kind of like for those people that watch F1, it's like putting an F1 engine on a go-kart. Unless you understand what kind of technology and risk you're working with, you don't need to buy the expensive software. You need to understand what you're doing first. And so when we look at every organization that uses watch lists, how should it make that decision? So, and this is a very manual, quality-based decision that feeds into the artificial intelligence. I don't say that artificial intelligence is, of course, very important, but it feeds into something bigger. And so the first thing that there should be is a financial crimes risk assessment. So what lines of business does the organization have? What types of customers does it have? What types of products does it have? All these things are very important. Based on the financial crimes risk assessment, you then look and see, all right, we need to do a list management process. And oftentimes that is based on, that can be more expansive or less expansive than kind of the risk rating from the financial crimes risk assessment. But if you're a U.S. institution that only does business in the U.S., for example, then you probably only need to screen U.S. lists. However, let's say you are a U.S.-based institution that's in northern New York, you're very close to Canada. You have a lot of people that might do business in Canada or even might live in Canada, have an account in the U.S. So in that case, you would want to screen Canadian lists as well. So every institution will have a different risk tolerance and a different kind of risk threshold. The moment you start doing anything international, now, of course, you need to screen lists from every single country you do business in, but then there are other things that are you may want to do as well. So no, in the US, you are not legally required to screen the United Nations lists, but you may want to do that. With the current war going on in Ukraine, you may want to screen European Union lists against Russia, even if you don't do business there, because there's going to be a lot of kind of dirty money fleeing Russia and trying to get out. So you start with the financial crimes risk assessment. You have a list management process. You start with only the lists that you are legally required to use. Then you use lists that help mitigate a risk that is identified in a risk assessment. One of the biggest kind of errors I've seen is where people add lists that don't mitigate a risk you have. So, for example, if you're an institution, if you're a bank or a fintech that only serves other businesses, you have no retail customers, then there's no point for you to screen a list of, let's say, potential individuals involved in fraud. If the list is only individuals, yes, that's a good idea in theory, but if you have no retail customers, then you don't need to screen that list because it's useless. So two very interesting examples that I've seen. One which is kind of a bank being extremely conservative and possibly even disorganized. Another one is a bank being extremely aggressive in what it does not screen. So in the case of an organization being very not on top of it, shall we say, I've seen a bank screen the 9/11 hijackers list. So there is absolutely no reason to do that. All of the 9/11 hijackers have been dead for a very long time. And I cannot think of, and I thought about this, I cannot think of any single risk based reason to screen them. But there's a major vendor out there that has this list, and when this bank that I won't name was going through their process, that was one of the lists that they selected. So it clearly shows that there's not a process. And okay, you can spend a lot of money on expensive AI, but it's not going to do you a lot of good if the input is not good. On the other hand, I'm familiar with one case of a Chinese bank in New York that does not screen export Commerce BIS export control lists. This is an extremely aggressive position, but they got their lawyers to review it. They told the regulator they were doing it, and there actually isn't a regulation that financial institutions must screen this. The bank is taking a risk. However, a lot of the organizations that are on the Chinese export control lists are the Chinese banks' customers. And most of the payments are correspondent banking payments. So they're not actually for exports. They're payments that are being routed for New York. And so that Chinese bank said, look, we're stopping all of these payments for no reason. Nothing's being exported from the US. So we're not going to screen it. So you can be pretty aggressive, but important thing to note is that you do need policy and procedures for every type of list hit. So if it's an export control list, what do you do? If it's a sanction list, what do you do? If it's an Interpol or an FBI most wanted list, what do you do? That's a very good example because there's no legal requirement for banks or others to screen the law enforcement most wanted lists. But it's a good idea. So, okay, your bank decides to screen these lists. When you get a hit, what do? You should have a policy and procedures in place before you say we're going to screen this. Before I move on to the next kind of part of the talk, I want to just check if anyone has any questions. Okay, no questions. All right, so now that we've talked about watch lists, what is the data quality that you're bringing in? This is where we begin to really talk about the artificial intelligence, because the data quality of watch list sources is terrible. And so seeing as the source's data is terrible, you cannot do apples to apples matching. And what I mean by that is you can't just compare a name to a name or an entity to an entity, a vessel to vessel, because most of the time you don't know. And you don't know on the watch list side, and oftentimes you also don't know on your own side. So where AI comes in, I think, really is to being able to label data at scale. So when you have data come in, is it structured? If not, can you extract insights from the data? And can you do so very, very quickly and efficiently? How much manual review is there? You need to identify all of the points that need to be screened. So transactions, loans, point of sale, investment, personnel, vendors. For each one of these points, are you getting all the data? So if you have algorithms going through and kind of assisting you with screening, are they going through the entire payment message? Are they going through only parts of the payment message? Are you aware of edge cases? Are you doing is it a logic-based system, which isn't really AI, or is it something that's based on machine learning? If it's based on machine learning, what kind of machine learning? Are you training a data set on your own data? Are you training on external data? These are all really important questions, and really my talk is more so about the questions you should be asking as opposed to the direct solutions, because in most cases there is not just one simple uniform solution. The solutions depend on the data and the data quality. And unless you're JP Morgan and you have 200 million customers in the US, and you can just train your data against a US population general data set, you need to do something more specific. names in the Northeast are different than they're going to be names in the Southwest, are going to be different from the Pacific Northwest. You're going to have different types of payment patterns. The moment you get into some, let's say in Maine, in the U.S., there's a very big Somali population. So there's a lot of payments that go from Maine to Somalia. So kind of getting back to the AI, you need to identify all points that need to be screened. So transactions, loans, point of sale, investment personnel, vendors. You need to identify, are you getting the right data? Do you want all the right data? Are you screening it against the right watch list data? So now that you identified, for example, in a payment message, there is a originator beneficiary information. Are you screening that against the right things from watch lists? For example, originator should go into name, screen against name, beneficiary, same against name. If there's address information, is your technology capable of extracting the address information and screening it correctly? And one kind of fascinating example is there was a fine against Apple for violating sanctions. The fine wasn't very big for Apple, it was several $100,000, but it was notable because it's Apple, the world's most expensive or valuable company, and they were screening their employees, their vendors, payments. They actually have a pretty robust sanctions program, but they were not screening. They were not screening app developers. So I probably would not have thought to screen that myself. But they weren't screening app developers, and that is where they got their sanctions violation. There was an app developer who happened to be on OFAC's sanctions list. And at some point, they did institute the screening. They discovered this and filed a voluntary disclosure with OFAC. So, how do we apply AI to obtain efficient screening? You need to scope your technology goal very clearly. Is it to reduce false positives? Is it to eliminate false negatives? Is it to eliminate level 1 work? If all three of these, each one should have its own implementation plan, because reducing false positives is a different goal than to eliminate false negatives. So each type of goal that you have with the AI should be scoped. Each one should probably have its own budget. Each one should have probably its own project manager. They might need to proceed on different timelines. The simplest use case is identifying types within data. So this is something that we like to start with our clients is, when you have information come in, is your data labeled according to type? For example, Peter Piatetsky, he's an individual. Castellum AI is an entity. Right away, if you're able to determine that, you can cut down your screening enormously. And it drastically reduces total numbers. And another thing, I know I only have 2 minutes left, but you want to work on something that we call match memory. So it's ensuring that once you have a match and you, let's say, clear it as a false positive, that your system is able to remember that. And if you're able to remember that, again, that will further reduce your false positives. However, something that wasn't on a list yesterday might be on a list tomorrow. So that's very important to note, as we're seeing with the global sanctions against Russia. Thousands of names have been added in the last several days, and all of those names were ones that were, legal to do business with just several days earlier. You do want to keep on keeping track of gaps. Why did some items take longer to close than others? Is there a pattern? For example, is it an uptick of risky cases that's causing something? And this is after the implementation. This should be communicated to the business. Is it a question of missing data? Do you need to be doing more data enrichment? Is it a dirty data issue? If it's a dirty data issue, then you need to spend more time in preparation. So, long story short, effectively using technology in screening is the process of repeating these steps continually. It's not easy. and it's often not fast, but the rewards are tremendous. And the main thing that I would want everyone to take away from this is these projects need to be scoped, and they need to be kind of have very clear goals in mind. Otherwise, you will not get value out of it, and you will go over budget. So, with that, I'll stop, and happy to take kind of any questions.
Sure. So I cannot see any questions, Peter. But yeah, thanks a lot for presenting, Peter, and giving your thought process, showing how we can automate the compliance and the other stuffs in that. Thank you for your thought process, and love to stay connected with you, Peter.
Thank you very much, Nathan, and thank you to all the other speakers as well.
Yeah, sure. Thank you. So we'll quickly move to our last presentation for the day, guys. We have Pranav Kansara, Senior Director, Analytics and Insights in TCS. His topic is Potentials and Perils of AI in Banking. Yeah, Pranav. Pranav, your voice is not coming. Your voice is not audible. Okay.
Okay, can you hear me now?
Yes, we can hear
Double,
you.
yeah, I think I was double muted. Okay, so those of you are there, I hope you're still awake and attentive and not hungry. I know it's probably, if you're in the US, closer to lunchtime or past lunchtime. So bear with me, I'll take 15-20 minutes. I think there's an advantage to being last and there's a disadvantage. A lot of the good speakers who've spoken before me, I think they've touched upon a lot of different important aspects as it relates to the use of AI in banking. The panel discussion was absolutely amazing and gave a lot of good insights. And really, if I look at my presentation, the good thing about it now is you can really consider it, and the way kind of I wanted to go about it is you can probably look at it as a climax, right? It's kind of summing up everything together, what has been discussed over last 4 hours. And coincidentally, if you see my presentation, you'll you'll see a glimpse of almost all of the topics that were discussed during the day. So more of a synopsis. Um, I plan to. My topic for today is the perils and potential for AI in banking. And the way I plan to go about it is I'll set the context of why it is necessary to be AI centric, though it is almost given these days. But I think some important statistics I would like to show, and then couple it with the use cases, the benefits, more importantly, that businesses can derive, that banks can derive through core AI implementations, and then leave you with a couple of emerging areas that, as an outsider, a lot of the clients that we spoke, a lot of the speakers before me, there were a few who are in the industry. Um, as part of TCS, and I get to work with 100 plus banking customers in the US region. Talk to a lot of these banking CXOs and understand what they're doing, what they're not doing. And so I would like to throw some insights into probably what are a couple of areas that banks are not putting too much attention on as it relates to usage of AI, and probably just leave it with that thought, right? So, at the outset, uh, needless to say, but very important to understand in the context of AI, is the power of AI is when you multiply it with the power of humans, and not when you divide the power of humans by the power of AI, right? So the success that you will obtain is by way of humans the power of AI and multi-fact as against AI, from the for the objective of cutting down the work that humans are doing. Okay, so that is at the outset very important to understand. Then every action that we take of using AI for productivity improvements, for automation, etc., has to be coupled with how it can multiply the power of the humans who are serving those needs today. Uh, so with that, I just want to put in a few some statistics here, right? And what I've done is just a simple comparison of two classes of companies. One is your traditional banks, and second is your fintechs. And this phenomenon has been explained very well with the example of Ant Financial and Bank of America in the book Competing in the Age of AI. It's a beautiful book if you want to read. And it's kind of pretty evident, right? If you see the likes of Wells Fargo, JPMC, Bank of America, just take three of them, versus the core fintechs, PayPal, Ant, and Square. We look at the difference in number of people they employ. Uh, you know, fraction of them, 5% to 10%. Now compare it with the revenue per employee that these companies generate. So, for example, based on 2020 numbers, Wells Fargo is somewhere in the 300K mark. Look at Square, about 6 times, 1.8 million per employee, right? And if you relate it to the message that I gave on the previous slide, look at the potential that these banks have given the employee size or the employee strength that they have. Just imagine if this employee strength, 300,000 employees, were given the strength of AI, what they could do. Here, Square, 1,000 employees are given the strength of AI, they could do this. If this size, employee size, is given the power of AI, think of what it can do to Wells Fargo, right? And just couple it with some of the statistics that we are seeing, like Gartner CIO survey says that banks' adoption rate of AI software is only about 25% today. Now compare it with the fintechs, I'm pretty sure it will be much higher, right? So there is a huge scope of improvement, even though for last 2 3 years, and we've heard during the calls today what COVID has done in terms of adoption of digital, in terms of digital adoption at these banks, and the adoption of AI. But there's a long way to go for most banks as we see it. Um, and in that context, right, how are these fintech companies which are born digital, how are they able to do it? How are they able to generate so much amount of revenue per employee? How is NM Financial able to serve 10 times more customers than Bank of America with 5% of their employee workforce? The reason they are able to do it is the power of AI. And what power of AI gives them is the ability to scale exponentially. They don't need to, for serving every 100 customers, they don't need to add one more person to their workforce, right? The scale is exponential. Serving every additional customers, the incremental cost that they have is nearly zero. Okay, so that is where the exponential power of AI really comes into picture, and that is the reason these companies, if you are truly AI centric, you will make complexity your friend. You will make scale your friend. The more you scale, the more AI gets to learn, the more AI becomes efficient, and the more benefits an organization gets. Right. So, with that premise, and showing what kind of scope exists for banks to really benefit with AI, let's spend some time in terms of what are those benefits. And this slide and the next slide probably would be some summarization of the use cases that we've heard throughout the day. Banking is a very complex ecosystem. You talk about When you talk about banking, it's consumer banking, commercial banking, institutional banking. Each of them serve a different classes of customers. Each of them have so many different product lines. So consumer banking itself will have checking, credit, checking out accounts, saving accounts, CDs, credit cards, mortgages, autos, personal loans, so many products like that. Similarly, commercial and institutional banking. Uh, Broadly, three categories of benefits. It can either give you significant lift on your revenues. It can give you significant lift in your bottom line by increasing the productivity of the employees and reducing the costs, or it can give a significant increase in the customer satisfaction. Three broad classes of benefits that AI can give you. And within that, if you look at some of the benefits, so banks can increase their customer satisfaction, significantly increase the cross-sell, upsell, increase the effectiveness of their campaigns. Truly socially responsible banks can, I'll give you quote a couple of examples of what banks have done. Increase the social impact, reduce the fraud losses. We've spoken about the financial crimes and money laundering, increase in lead conversion, reduce the loan processing time. Some of these topics has been covered at length today, right? Increase in the credit offtake and improving forecasting accuracy, many more. Now, if I superimpose these with the use cases, And what are those use cases where natural language processing, deep learning, graph machine learning can really come to the fore? Augmented reality, virtual reality, all these technologies that we've spoken about throughout the day. You take your attrition models, things like use cases like complaint analytics through NLP. You can truly understand what your customers are not happy with, and then implement those strategies to increase your customer satisfaction. I gave the example of the social responsibility. There's a very good example I came across of Scotia Bank, where during COVID, what they did was they used AI and machine learning to understand which of their customers are likely to face financial difficulty in this scenario, and use that information to proactively reach out to their customers and offer them additional credit or additional financial help. Now, this is an excellent use of AI and machine learning in the context of helping the society in need. Fraud prevention. You take example of let's say American Express, right? American Express, as per one report, late last year, they changed their fraud models. From your traditional techniques to machine learning based techniques, sequential RNN based techniques, and they have seen roughly 30% improvement in the fraud detection rates because of that. Those change in the modeling techniques and leveraging machine learning in a more sophisticated, advanced manner. We've spoken about the role that OCR, document digitization, can play. Even today, any loan processing that you do, a huge number of documents get exchanged in various forms, right? And uh, even though this AI has advanced tremendously, banks are yet to capture the full advantages of it, and really get away from all these manual processing of the documents. You talk about chatbots. I think during the discussions we've spoken about chatbots and IVRs. How many of you are really happy with the chatbots and IVRs that your banks offer? Right, tremendous advances in this technology, but I mean, I've out of every 5 times I have reached out to a chatbot for any point, 3 times I've written empty-handed, right, and then spent 30 minutes waiting for a contact center agent on the call. I think there's a tremendous opportunity in that, and that directly ties to the customer satisfaction to improve your AI to help interact with the customers much better. I don't want to be spending, pressing 6 buttons every time the AI asks me, "Tell me what you need." My kids are shouting from the background. How can AI really suppress all that background noise and understand what I'm trying to say, right? So, a lot of improvement opportunities that are there. We've spoken about credit decisioning. What role alternate data can play, right? AI is just, I mean, it's as good as the data that you give it. How much additional data can you give beyond your own organizational data? Leverage the ecosystem data, leverage open data. A lot of those points can come in to really improve the customer wellness. So that's really the potential, right? The huge amount of impact that AI can make to the business. As TCS, as I mentioned, we work with hundreds of customers, and we are working on delivering these business outcomes through AI. We are seeing significant lift. Something like campaign effectiveness. We are seeing banks improve their campaign effectiveness with, by 100 or 200, to 200 percentage points by leveraging these machine learning models. So the amount of opportunities that AI presents is immense. It's important to use it responsibly, though, and that is where we come to the risks that banks face by using AI or not using AI correctly, and the role that the CRO can play in this area. Jacob spoke about it briefly earlier, and I think and that's what we are seeing across the banks. It's going to probably over the couple of years, it's going to just take shape completely. About the role that the CRO will play beyond the traditional model management to governing and managing all of the AI models within the banking ecosystem. Currently, most of them are at the pilot stages, but as these pilot models get into production, that is where the CRO's role is going to become very important. So, what are those risks? Um, Very quickly, the risks of the decisions of the AI being biased. Why? Because the data that is given, some of the labeling that is done on the data is biased. Who is doing the labeling? what are their demographics, what are their thought processes, that's all reflecting in the data. The selection bias, the data scientists that create those models, if they select certain features which they should not be selecting, like age or gender, or race, etc., and that gets reflected into your decisioning models. So it is explicitly prohibited, but how do you ensure that it will not even get access to these type of features? And also get you're not intending to include gender, for example, in your model, but you end up selecting 2 3 other features which indirectly imply the gender of the person. Then you're still incorporating gender in your models, like the classic case that we saw with Apple's algorithm for credit cards, when the Apple credit cards came out, and Goldman Sachs. So the kind of discrimination that it made against a certain class of people. Security: how do you ensure security of your data, of the platform, and of the algorithms? All three are very important. Data security, very heavy focus right now. Platform security, how do you ensure you don't get those adversarial attacks? And also, how do you ensure the security of your algorithms? Accountability is a very important fact. There is not a single, when AI makes a decision, it's not one person who is accountable. It's the entire ecosystem, organizational ecosystem, that is accountable. Be it the data scientist who built the model, the data engineer who provided the data, or the LOB who is actually responsible for that implementation. So shared accountability, shared responsibility is important. If you don't have the right procedures and the right expectation setting in this could again become a risk. And then finally, explainability, reproducibility, and traceability. These are three very critical elements. Banking is a very heavily regulated industry. And in a regulated industry, how do you make sure that every model that you have put in production, you are able to explain the decision that the models make, especially when you end up using the black box algorithms, the explainability of the algorithms themselves, and finally, the data that you're using for making those decisions. How are you able to reproduce that data whenever needed? How are you able to reproduce that decision if Pranav's loan application was denied, if I run the model second time, will it still come denied or will it come as approved, right? And how are you able to reproduce that decisions every time, the process of making those decisions, and the data that went into training that model which made those decisions. And finally, traceability of if something goes wrong, traceability to a person, like why it went wrong, who made that call, I mean, we spoke about the shared accountability, but the traceability is also important. Traceability to the systems and the risks that the systems face, and then traceability to the time, how far back you're going to go. And in all of this, the role that the CRO will play is going to become increasingly very, very important. No more just restricted to traditional regulatory and the models and the reports just for the regulatory authorities, but more importantly, managing the model risk overall across all the models of the organization. Couple of important parts, as I mentioned, we are working with hundreds of banks and talking to CIOs, chief analytics officers, chief data officers, as well as the heads of various lines of business. Everybody is focused on these types. So for every successful AI company, there are three critical elements. You need to have a very solid data platform. You need to have a very solid AI platform. And then you need to have a very solid and strong experimentation platform. Data platform will address that you're getting all the right data that you need of the right quality as and when you need it on a scalable basis. AI platform will ensure that you have all the right tools and technologies in place for your data scientists to go and create those models, run various hypotheses. But question is, what is not there right now is the experimentation. Is I have this model, I have this hypothesis, I have created a model, but where do I go and test it out in a real life scenario? Do I have an experimentation platform where I can launch 100 experiments on different segments of customers and observe the results? Today, it's a manual process, but truly successful organizations like Netflix, for example, are able to create a very, very sophisticated experimentation platform, which through which everybody in the organization is able to create the hypothesis, create a model for that hypothesis and create the analysis, run an experiment, measure the outcomes, pass on the feedback in form of the data to the data platform, and then again the AI platform uses that information to further enhance the models. So this is a very critical aspect. I strongly believe banks should start talking about what role, what are they doing to have a solid experimentation platform which could run those experiments both in a batch mode as well as a real-time mode. Another critical aspect I want to touch upon, and this is something that has been leveraged very successfully in another regulated industry like life sciences. So, and this is picking up in banks, but I think it needs to pick up speed much more. Is how do you harness the power of synthetic data? As we know, data is the food every AI lives on, and the larger the quantity of food, the fatter the AI becomes. But there are use cases where really you do not have that enough data. If you're a small bank, small community bank, you do not have the amount of data that an Amex or a Chase or a Bank of America will have in terms of the transactions and the fraud captured, and both data of frauds and as well as the larger data sets. So how can these banks, smaller banks, collaborate between themselves? Obviously, they cannot share the customer data as is. But thankfully, there are advances with AI where you could create synthetic data sets using techniques like generative adversarial networks and use these data sets uh, so you do not necessarily circumvent any regulatory requirements. You do not circumvent any proprietary requirements to keep those customer information confidential. But at the same time, you use those synthetic data to augment your internal data sets, increase the accuracy of your models, and even in certain cases reduce the labeling costs as well. Those are very well known benefits. But specifically in banks, you could even end up monetizing your data. Right now, they're not talking about external data monetization. Whenever we talk to banks, it's a strict no, right? It's Lord Voldemort. You cannot speak about that. But with synthetic data, that becomes a possibility. You could alleviate those security concerns around the data sharing between companies. You can engage that cross-company data sharing for those specific use cases. Maybe make a marketplace between these small banks where synthetic data can be shared and leveraged by everybody through common models, possibly. Right, and then significantly expedite your hypothesis testing and experimentation. Very important statistic I would want to quote. I saw this one of the Gartner reports. Is they're saying by 2024, which is probably another 3 years, end of 2024, if you consider 60% of the data used in AI projects will be synthetically generated. So it's a very big statement, and I think banks need to take concrete steps on that. Banks like JP Morgan Chase, for example, I was looking at their website. They have started giving out some of this synthetic data, maybe for research purposes on a request basis. I think it's something that is on the horizon, and every bank would benefit through it. Finally, uh, where does AI come in? Where does human come in? Does AI make all decisions? Does human makes all decisions? The verdict is really it depends, right? So, just a quick framework about when it is advantageous to have. So look at the bottom axis is who makes those decisions, and the y-axis is who supports those decisions. So for example, if you have very low financial impact, high volume, efficiency oriented transactions, it's okay for the AI to make the decisions and have automations in place where AI also makes sure tracks them and just gives you red flags if any. But some of those routine low impact efficiency oriented transaction where AI can make the decisions, human could be a supporter or a validator. But at the other extreme, for example, if you have very high financial impact, high subjectivity, and decisions which truly depend on your experience, then it's better to have the decisions made by humans and validated by humans. And this always evolves. So today, what is highly subjective, you capture enough data, it becomes objective, and then you can have transform from this model to this model where humans make the decisions supported by AI. With this, I want to end with the beautiful quote from this book, Competing in the Age of AI, that in an AI-powered operating model, The managers will be designers who will shape, improve, and control the digital systems. So very important. They will shape, they will improve, and they will also control these systems that senses customer needs and responds by delivering value. So with that, I end my presentation. I think there's huge amount of scope for AI to really improve your life as a bank customer, as well as your life as a bank executive. Thank you so much for listening.
Yeah, thank you, Pranav, for showing this lovely insight which you have shown today, and you have summarized it very beautifully. To wrap up, I would like to thank all our community partners and the technology partner Bit7 for making this event a huge success. The recording of this session will be published in our YouTube channel and will be posted on our social media channel shortly. Keep watching the space. And special thanks to all our speakers who are part of today's event, and the audience who were there from the beginning. And thanks to all of you. Please log into our website www.aikosco.io and like our social media channels. We'll be doing knowledge sharing topics, announcement about upcoming events and webinars, and much more, which will help you register and attend and make your horizon a broader way. Thanks to all the great speakers who have taken their time and shared their thoughts. Thanks everyone. Have a lovely week.